Hi, and thank you for joining us today for our virtual uranium conference. From an investment point of view, it's hard to find another sector with a stronger fundamental setup than uranium, and yet the uranium price is not responding the way you would expect to do with such a positive backdrop. According to the WNA, uranium demand is at 170 million pounds annually, and supply is between 140 to 150 million pounds, resulting in an annual deficit. There are 74 nuclear reactors under construction globally, with more planned, including the construction of 10 new reactors in the US, and they will require millions of pounds of additional uranium. The two largest producers of uranium, Kazatomprom and Cameco, have been very disciplined in production and have no plans on increasing production, even with higher prices. So the investment thesis seems very straightforward: rising demand, static supply, resulting in structural deficits. And yet the uranium price isn't reflecting this. Spot uranium remains well below the all-time high of $136 a pound, which was reached in 2007. For investors, that raises the key question: is this a mispriced market, or are we missing something? To answer these questions, we have brought together some amazing speakers, beginning with Ciampaglia from Sprott Inc., Jander from WMC, Mike Alkin from Sachem Cove, Justin Huhn from Uranium Insider, David Cates from Denison Mines, Phil Williams from ISO Energy, Leigh Curyer from NexGen Energy, Paul Hemburrow from Paladin Energy, Colin Healey from Premier American Uranium, and we conclude with Dastan Kozherbayev from Kazatomprom. I want to thank our corporate sponsor, Sprott Inc., a global leader in precious metals and critical materials investments. As a reminder, we're going to have an open chat on the right-hand side of your screen, so you can say hello or ask a question or make a comment. We're also going to be running polls throughout the conference to get your views on various topics, so keep an eye out for those. We also want to give a shout out to our good friend John Quiggs, who's a great resource for all things to do with nuclear energy and uranium. If you're not a follower, I would encourage you to check out his account on X at Quiggs99. Don't forget to subscribe to our channel, Bloor Street Capital, and you can also follow us on Apple Podcasts and Spotify. Thanks for your support, and I hope you enjoy the conference. John, thank you very much for joining us today. Well, we are living through some very tumultuous times. Aren't you glad you don't trade oil?
Yeah, uranium seems like a bit of a sea of calm right now compared to some of the other commodities that are getting whipsawed around on day by day, minute by minute headlines and actions, unfortunately, in the Middle East.
So we are here to talk about uranium, and despite the volatility that we've seen in the energy market and so many other markets, spot uranium has been relatively quiet. It's up small on the year, but now that we're almost through Q1, how would you characterize the activity we've seen in the last 3 months in the spot market?
Yeah, I mean, it's obviously been a tumultuous and volatile year for sure. And obviously a lot of that's been driven by investor sentiment and obviously what's going on in the Middle East and the uncertainty related to that. But uranium obviously had a really strong start to the year. It started at about $81 a pound, touched briefly about $100 a pound, which it hadn't been at for almost 2 years. And with the commencement of the war in Iran, the prices drifted down into the mid 80s per pound. So we've definitely had a cooling off, as people have kind of stepped away and de-risked and taken money off the table in terms of not really knowing how this is all going to play out. But I think the longer term fundamentals, the story remains very intact. And we would argue that this recent energy crisis, no matter how long it lasts, is another, I think, positive development longer term for uranium and nuclear energy. And this is because you've seen how resilient nuclear energy is relative to oil and gas, which has obviously been hugely disrupted in the world. And this is why I think politicians in the last few years have now gone through two energy shocks and have now, the last, I think, holdouts have publicly said, I find this kind of interesting. In the last 2 weeks, we've had the president of the European Union as well as the German chancellor both publicly acknowledge that closing down nuclear energy was a strategic blunder. And for these two individuals to finally fall on their swords and admit that policy errors were made, really highlights that nuclear energy is the perfect offset in terms of the volatility of oil and gas markets, which operate in more of a just-in-time framework. Nuclear energy does not obviously have to rely on daily supplies through pipes or ships to have critical fuel. And I think we've been talking about this for 4 or 5 years, that this is very similar to what happened in the 1970s when OPEC squeezed the oil market, and we saw countries respond by basically building out nuclear energy. And I think the recent actions, unfortunately, in the Gulf will help to further galvanize this shift back to nuclear energy, which is ultimately very bullish for uranium.
So let's talk about the Sprott Physical Uranium Trust, or SPUT. It was very active in the first month of the year, or the first 2 months of the year. Many investors have been asking about the cap limit of 9 million pounds, which is the total amount that SPUT is allowed to buy. You've already acquired just over 5 million pounds. Maybe you can just speak to that.
Yeah, well, I think the amazing thing about Spot is that when it is on, it really can go and obviously raise a lot of capital over a short period of time. And we just had an investor call with a large bank last week, and I showed a very interesting chart showing our uranium procurement from the point that President Trump won the election in November of 2025 to June of 2025. We had bought zero uranium over that period of time. And a lot of investors were questioning the trust. Was it basically broken? Is it going to be able to get back to buying uranium? And we basically said, look, this is very investor sentiment driven, and it's also purely a function of what you want to do with your money in terms of how you want to express your view on the uranium space. Now, from middle of last year to today, we've purchased 14 million pounds of uranium after that little 6-month dry spell. And so I think that is a very strong signal that investors are very bullish on uranium, and they continue to view the market as being attractively valued. And they clearly saw last year's dislocation as an opportunistic trade that they got behind. So for this year, we finally had to renew our prospectus in January, and I'm very pleased to report it was a seamless process with our local regulator. We have a 9 million pound per calendar year purchase limit. And so far for 2026, we're already at 5 million. And we've been getting a lot of questions from investors around, well, what happens when you hit that 9 million pound limit? Is the trust going to basically be on the sidelines? Is it going to be dormant? Are you going to raise cash and wait for the next calendar year to clock over? And the message we've been starting to provide to investors is that in our prospectus undertaking, it is crystal clear that 9 million pounds refers specifically to spot market purchases, which is defined as delivery within 365 days. And we have never taken delivery past 6 months. That's the longest we've ever gone. And what that basically means is that if we got into a situation where we wanted to purchase uranium beyond this spot market definition, beyond 365-day delivery, that would not count against our annual limit. That is our interpretation of the prospectus, and that is our undertaking. So this is basically additional capacity that we could use. Now, what are the implications of doing that? Well, you're basically asking a trader or a bank to carry that material on our behalf. So they need to be paid for that. There's usually obviously a cost of capital plus some spread. So there will be a slightly higher cost to buy the same amount of pounds versus buying them with, say, a 30-day delivery window. But in the grand scheme of the trust now holding 80 million pounds of uranium, we think any additional friction costs related to this capacity issue is de minimis. It really will have no impact, no material impact, obviously, on the NAV, given how big the fund is right now. So this is a contingency plan. We still obviously have about 4 more million pounds to go, but this is the plan we've been starting to message to investors over the last few weeks.
And John, what are the mechanics associated with increasing that 9 million pound cap if you want to go to 12 million or 15 million?
Yeah, well, this is the limit that the regulator put on us back at the end of 2023. And we basically resubmitted the prospectus with the exact same amount, 9 million pounds. We didn't really want to retest that number. We felt comfortable with 9 million. Last year, we got to 8.6 million. We got very close. And the number has basically been put in to essentially, create a limit in terms of how much material we could buy in the market so that we don't unduly disturb it. And I think it's fair to say that the regulator renewing our prospectus for another 25 months, which is what the duration of these prospectuses are, so they've now done two 25-month prospectuses with this 9 million pound per limit, I think is a good equilibrium. We're happy with it. We understand what they're trying to achieve, and we are very comfortable operating the trust within that limitation.
And John, the trust was very busy the month of January. Why was there so much volume going through?
Yeah, I think it was really a function of two things. One, our prospectus was coming to its end, the prior one, and we really weren't in a position to raise a lot of money or deploy, the capital to buy more uranium. So when we renewed the prospectus, I clearly believe there was pent-up demand. That was obviously well demonstrated when we had two very large block trades done by two different institutions back-to-back days, which were pretty sizable. One was a $50 million block trade that we did through our at-the-market offering. The other one was $125 million US that was done the following day, and I think that got the market very excited. Between the prospectus renewing and those two big trades, really kind of piling on, the market got pretty bullish, and we briefly touched the $100 a pound for a few days. It's interesting because when we were at $100 a pound back in January, February of 2024, there was massive exuberance about the space. There was massive concerns about supply deficits. So it's interesting that we were able to touch the $100 again without any of that exuberance. I'd say that the market's been a lot more level-headed and more dominated by more longer-term fundamental-driven investors versus momentum chasers that we saw 2 years ago. So the market feels constructive. Putting aside the last few weeks, obviously all the uncertainties and risks created due to this war in Iran, I think once the dust settles there, and it seems like that all parties need an off-ramp here, it seems as though uranium will get back to doing what it's doing. We are starting to hear a lot of chatter about uranium utilities, or utilities getting back into the market to buy uranium. We are starting to see some RFPs hit the market. We are hearing that utilities are preparing to come back to buy uranium this year. And I would say the most notable announcement we saw was obviously the country of India, their state-owned energy company, making two multi-billion-dollar contract announcements, one with Kazatomprom, one with Cameco, to ensure they have long-term security of supply. I think that sends a very bullish signal that not only do you have China buying large amounts of uranium, now you've got the Indians coming in. And it should signal to the market that everybody needs to get in line to lock down their own supply, because these big state-owned entities are doing exactly that.
Yes, and one other thing I think is very interesting about India, they have 25 reactors, 3% of their grid comes from nuclear energy, so there's lots of room for upside there.
There is enormous. I mean, when you think about how much electricity per capita that India uses, it is still very, very tiny. And a lot of people, get excited about things like AI data centers, and they should be. But I go back to something really, really basic. Think about somebody in India that gets their first air conditioner. It's amazing how much electricity those things require. And so if you think about a population of well over 1 billion people and only 8% of people have air conditioning, it is astonishing how much things like buying appliances and air conditioners as people accumulate wealth, how much load growth that creates, obviously. And this is why developing countries like India are so focused on adding more clean sources of energy. Obviously, India has pollution, and air quality issues from time to time. And obviously, nuclear produces zero greenhouse gases.
John, you mentioned something earlier I just want to clarify on. You mentioned last year there was a 6-month period where there was relatively little trading going on within the spot product. What was happening there during that 6-month
Yeah,
period?
well, it was more about the vehicle raising new capital in order to buy more uranium. So there was a period there where the vehicle was trading. It was obviously at a discount to NAV over that time, so it couldn't raise new capital. And it basically was, I think, the single largest period since the trust's inception where we didn't go without buying uranium. So this was kind of an anomaly, and it was really one thing. It was basically a new president with everybody was waiting to find out, what was going to happen with tariffs, trade relations, the war in Ukraine, the Inflation Reduction Act, other energy policy. I mean, just about everything that could impact the energy markets was up in the air. And we obviously saw a lot of investors and utilities, step to the sidelines to look, wait for clarity. And then obviously when we started getting clarity and the clarity was positive, they stepped back in. So there was a period of dormancy, so to speak, in terms of uranium buying, and and then it led to a period of very accelerated pent up demand once investors got some clarity. So I think that's one of the takeaways is, things can look kind of gloomy for a number of months, but then you get a catalyst and it's game on again. And this is why I think with any of these thematic or sector investments, investors have to have conviction with their long-term thesis, because you'll get flushed out and whipsawed around if you try to trade these different headlines and different developments. And I think if you stay the course and you dollar cost average and buy these dips, it generally works out pretty well for people.
And John, I have to admit, I'm somewhat surprised by how spot uranium is hanging in here at $85, give or take. Does that indicate to you that there are buyers out there like in the low 80s, keeping that price in there? And is that why it hasn't come off?
Yeah, I think, look, the term price, which we haven't talked about at all, which is this base reference price that gets escalated for future delivery. It's at $90 right now, and it's been going up for the last 6 months. And I should point out that the $90 per pound is the highest it's been since 2008. So that is a very bullish sign, and it tells you what the direction of travel for the uranium price is. It's up. And if the spot price drifts too far away from that term price, you'll have participants come in, buy uranium, and basically sell that uranium forward maybe a year, maybe 2 years from now, and keep that relationship quite tightly tethered. This is what they call the carry trade, where you take advantage of short-term price weakness in the spot market, you sell it forward on a very short-dated contract, and you lock in that spread. And so I think this is what's really helped the uranium price be more, I think, cushioned in these downdrafts, is that ultimately this carry trade mechanism is a very, I think, powerful arbitrage incentive to keep those prices without getting too far, apart.
And John, you and your team speak to investors all over the world, institutional investors, family offices, so on and so forth. But what are you hearing from these investors? Are they hanging in there with the trade, or are they getting frustrated?
I think the group of investors that we have, I think, well placed in the trust right now are thinking about this in the next 3 to 5 years. And they're not looking at this in the next 3 minutes or 3 days or 3 months. They're viewing this as a thesis that's going to play it over the next 3 to 5 years. And this is basically underpinned by the fact that we're not going to have meaningful new supply coming to market over that period of time. I should note that obviously 2 Canadian mining permits for new uranium mines have finally been granted after multi-year review processes. That is very bullish for the industry and those particular companies. Now, there are risks that remain. There's obviously construction and timeline risks that will have to play out. But I think many investors believe that without new meaningful greenfield production coming to market in the next 5 years, the market is going to get tighter and tighter and tighter. And again, these utilities need to buy and lock down uranium many years in advance. And we're getting to the point where their future uncovered requirements are starting to or will start to get really big around the year 2030, right when some of those new mines are expected to come online. So it's going to be, I think, a real pivotal development for the industry, whether these mines get built on time in order to start covering those future requirements. So supply discipline is still the main theme from the producers. We're still seeing challenges with some of the existing mines, and no greenfield production of meaningful size coming online for the next 3, 4, 5, 6 years. All points to a very tight market, which many investors believe will be, will act as a very powerful catalyst to get the price significantly higher. I should also mention that when you look at the term market, which was very quiet until the last 2 months of the year, it obviously is indicating much higher future pricing with the price cap. So these are like the maximum prices that a utility could pay for future delivery. Now at the $150 a pound mark, and we're even hearing that some producers are offering uranium for future delivery with no price cap at all. Meaning, if the spot price of uranium is at $200 at the time of delivery, the price is $200. I think for a lot of utilities, that creates an enormous amount of sticker shock and a real sea change. Because remember, it was only 4 or 5 years ago where utilities could lock in the price of uranium at $30 fixed, never worry about price caps and price spikes and all the rest of it. So it is obviously an evolutionary process where utilities and producers are playing a game right now, trying to reset the marks in terms of where producers are willing to sell uranium. And I think it's fair to say that producers are feeling like they've got more negotiating power than they've had in a decade plus. And so they're using that and making these utilities, come to them and sign on the dotted line, because they know at the end of the day, utilities will have to buy. And this is the last point I want to make is, you cannot substitute and thrift uranium. We hear a lot of times about, the price of copper gets too expensive, so let's go to aluminum, or the price of silver gets too expensive, let's use copper. There's none of that substitution thrifting effect that can happen in uranium. You have 100% inelastic demand, and the producers know this, and they know what the future supply looks like, and they know what the future demand looks like, and everybody has to get in line and lock down their supply. And that's, and the Chinese and the Indians and the South Koreans are basically doing that right now.
John, as we both know, there's been many positives associated with nuclear energy and also uranium in the past few years. The U.S. government, they are going all in on this trade. Last year, 4 executive orders were introduced to expand the use of nuclear power and also to build out the uranium supply chain. They want to build 10 nuclear reactors or start the construction of them before 2030. We also saw uranium added to this critical materials list, and I could go on and on. But you think with all these positives, that we would see a much higher uranium price and therefore much higher equities, but we're not. And a lot of investors, especially the retail investors, are getting frustrated with this trade. What would be your messaging to these investors?
Yeah, well, this is a very slow moving industry. You make these announcements about $80 billion of funding in the United States to build new reactors, but there's very little detail. There's very little announcement around who's building them, where, and what. And so I think there's been a lot of very bullish news, which indicates this massive change in policy back to this technology. But it's going to take time to actually come up with the details and share those publicly. So that is going to happen in due course, obviously. I think the equities, obviously, up until the last few weeks have performed really well. I mean, last year, most uranium indexes, including our own, were up 50, 60% for the year. There was a point where those indexes were up another 50% for the year-to-date period before we obviously had a bit of a risk off, and obviously the war led to a sell-off in a lot of those companies. But I think the stocks have actually been more forward signaling and obviously performed better in reaction to all these positive news developments. And that's because investors are driving those share valuations as opposed to utility fuel buyers, which are moving a little bit more on a mixed basis, obviously. Some are moving, more aggressively, like we talked about. Some are still just getting ready to get back to market to buy. So very different markets, I think, very different signals that they send. But the uranium stocks obviously, had almost doubled, I think, at one point over a year plus period. And so they did perform incredibly well. And obviously, we've had this correction over the last few weeks, which hopefully represents an interesting buying opportunity once the dust settles in Iran.
And John, when we look at the next 3 or 4 months, are there any relevant catalysts that investors should be aware of that might get the uranium price moving again?
Yeah, well, clearly we need to have some kind of an off ramp in the Gulf. It's obviously creating massive distraction and disruption. That's thing one. I think every time we get some news that things might be cooling off, you see an immediate reaction to the valuations of these stocks across many sectors. In terms of uranium specific, we obviously need to see more contracting activity and market signals. It was a very odd year last year where most of the uranium contracting happened in the last 2 months of the year. So in our minds, that creates pent up demand for this year. So let's see if those contracts get signed. And we obviously need to see more details around these public-private partnerships with respect to building new nuclear energy capacity in the United States. We're obviously seeing a lot of interesting developments on the small modular reactor front. Those are going to start to become more realistic as shovels hit the ground, and that's starting to happen in places like Ontario. Um, and I would say the last thing is really just what's going on in Europe. You know, are they going to continue to pivot back to nuclear energy? Spain is the last country there that is still on this path of phasing out what they have. Let's see if this recent energy crisis shifts sentiment, and places like Japan continue to turn on more reactors that have been turned off for a very long time. So lots of interesting things going on. I think there's a lot of excitement. We need a little bit more detail with respect to some of these partnership programs that are being announced. It will be very interesting to see what roles Japan and South Korea have to play with some of the build out in the West. They obviously have track records of, building these reactors and obviously supplying all the critical components. And we'll see what happens in Ukraine, which unfortunately is now into its fourth plus year, and how that may impact the fuel chain. But a lot of interesting things. I'm sure this is a very headline driven market, and that's why it's very hard to predict. You just don't know when a headline is going to come out and the market's going to move on you.
Well, John, this has been a great discussion, and I want to thank you for being with us today. And as we wrap up, you and your team at Sprott do a great job of producing research focused on nuclear energy and also uranium. And if investors would like to access that information, where do they have to go?
Yeah, please visit our website. Obviously, Sprott is the largest manager of uranium-related investments in the world. We have multiple funds, not just the physical commodity fund, which we've been talking about, but a number of uranium mining ETFs that are listed in Europe and the US. Please come to our education and insights section of the website. We have a lot of great reports, webcasts, podcasts that we talk about investor education around many of these topics, not just uranium, but copper, gold, silver, platinum, palladium, and all of these things are on our website. So please start there and reach out to us if you want to talk to us directly.
John, once again, thank you.
Thanks for having me.
Hi, I hope you're enjoying the conference. Did you know that 80% of our viewers are not subscribers to our channel, Bloor Street Capital? So please hit the subscribe button and also hit that thumbs up button. Thank you for your support. David and Geoff, thank you very much for joining us today. Denison Mines will be transitioning from a developer to a producer over the next 2 years. And David, I want to discuss this process with you. And Geoff, with you, I would like to discuss what's happening with commercial activities and also contracting. David, I want to begin the discussion with you. Denison received its final permits to start construction at the Phoenix ISR mine, and now you can move ahead with site preparation and construction. With regard to site preparation, what work has been done and when can you actually start construction?
Yeah, Jimmy, it's been an incredible ride for us to be at this point where we are talking about starting construction. An incredible accomplishment for our team to have Phoenix permitted as the first new Canadian uranium mine approved for construction in over 20 years. In terms of what's happening and at site, I can comment that we are in a position where we have started site preparation work and are commencing construction work in the month of March here. And that's part of a 2-year construction process for the project.
And David, with regard to construction at Phoenix, maybe you can just touch on some of the key priorities that you will try to accomplish in 2026.
Yeah, Jimmy, our mining method's a little different than what we've seen in the region with ISR mining. And so our critical path doesn't involve things like shaft sinking or opening a pit. For us, 2026 is really focused on two main objectives. Obviously, civil and earthworks and preparing our site for our slab pour so that we can start building our process plant into the second year of construction and perhaps during the winter months. That's part one, and part two is starting the well field work, in particular the perimeter freeze fence. That does take in the range of 12 to 14 months to establish once all the freeze infrastructure is in. So we would like to be able to get power distribution on site and the freeze wall infrastructure in place so we can start the ground freezing process. Those are our two priorities in the first year of construction.
And what's the best case scenario? When can we expect production?
Yeah, with our schedule that we have in place, we're looking at about 24 months of construction, and so we are on track for first production by the middle of 2028.
And when Phoenix is up and running, what will be the mine life and what will be the annual production?
Jimmy, Phoenix is estimated to have about a 10-year mine life. Average production over that period is around 6 million pounds a year, but we'll see production front loaded in the first 5 years, more in that 8 to 9 million pounds a year range, and then lower in the final 5 years.
And I noticed that you released a new CapEx for Phoenix, $600 million. How does that compare to the previous number?
Yeah, CapEx update was from the beginning of 2026 and reflected quite a lot of work that we've done over the past few years regarding engineering design. We're near 90% total engineering at the time of that update, as well as significant procurement. And so that put us in a position to update the market on our CapEx. We reported that we are expecting post-FID CapEx in the range of 600 million. That does represent an increase from our 2023 feasibility study. That study was based on 2022 dollars. So we've certainly seen some inflation in that interim period. And we've also seen some improvements in our cost precision, which has led to certain other costs increasing, but minimal design changes. One of the design changes has added cost, and that is that we'll actually be deploying a full array of large scale or large diameter wells in phase one of the well field, which is part of our initial CapEx. And large diameter wells give us maximum operational flexibility. So each well can be used for both recovery and injection. In the feasibility study, we had a slightly lower cost strategy of large diameter and small diameter wells being intermixed, where a small diameter well could only be used for injection purposes and not recovery. So with that tweak, we're able to have greater control of our well field, and it sets us up to achieve our production rates and maybe some additional optimizations as well.
And David, just because you touched on inflation, I have to ask you about the oil price. We've seen a lot of volatility in the last few months. It's been as low as $60 in January, as high as $100 in the month of March. How does a higher oil price impact the economics at Phoenix?
Well, higher oil prices certainly don't help with costs. We do have materials that we'll be transporting to site, and we will have equipment operating on site. But our project is unique in that we are situated on the provincial power grid. And in earlier this year, we announced that actually the provincial power grid has been brought to our site and is ready for us to connect to it. So our energy intensive activities, for example, establishing our freeze wall, we are set up to be able to power that from the grid, which means we will be largely insulated from the volatile costs of diesel that you would otherwise need when developing a project like this in a remote region.
David, I want to move on now and ask you about another one of your operations. Denison, along with its JV partner Orano, is producing uranium at the McLean North Sabre mine. Can you provide an update at these operations? How are things progressing?
Jimmy, it's been a very positive startup and commissioning of the Sabre mine at our McLean North deposit. We're very grateful for the excellence of our partner and the operator of that project, Orano. We achieved Denison's share of production, just under 150,000 pounds packaged finished goods from operations in 2025. The mine has been operating well, and it has been feeding to the McLean Mill, which of course is a truly world-class processing facility. And the production has gone pretty seamlessly in terms of co-producing with the ore coming from the Cigar Lake mine. So it's excellent for us to be back in production. And while it seems like 150,000 pounds is maybe small compared to the type of production we're talking about for Phoenix, uh, the production coming from this mine on a 100% basis does make it one of the largest uranium mines in North America, producing in that range of 700,000 pounds in 2025 alone. So, really a great success story to rapidly ramped up and achieve production in 2025, and certainly more to come.
Geoff, I want to turn the discussion to you now. Denison has committed to selling 5 million pounds of uranium. Can you explain the details behind this contract?
Yeah, Jimmy, certainly. So this contract is one of multiple agreements that we've entered into. But importantly, this contract achieves both financing and commercial objectives. And so this contract relates to 10 million US dollars of upfront funding that we received partially in 25 with the balance to come in 26. In exchange for that upfront financing component, we'll deliver a discount per pound as all future deliveries are made, with those deliveries coming notionally as Phoenix begins production.
And Geoff, what other transactions can we expect in the coming months in terms of contracting?
Yeah, thanks, Jimmy. So we are also in advanced negotiations for an additional 12 million pounds of sales commitments. So we certainly expect to see some progress and be able to update the market as those are finalized and further advance.
And maybe you can speak to how your strategy at Denison will be different from NexGen's and Cameco when it comes to selling pounds.
Yeah, absolutely. So, I mean, uh, it all starts with basically a Denison-centric approach. And what that really means for us is looking at our unique circumstance, whether that's our assets, our balance sheet, and market position. And with Phoenix, our flagship asset, being a low-cost mine, having a robust balance sheet, these are factors which allow us to be able to tolerate greater variability in price relative to other producers that may require a greater degree of price certainty in order to be able to maintain margins or service debt. We have a robust view on the fundamentals for uranium, so being able to pursue market-related pricing structures and capture that potential upside is certainly an important part of our strategy. But then also, we have to recognize our position in the market. We will be a meaningful producer, especially when you think about who has potential supply available in the next 5 years, uncommitted and from Western sources. But we won't be the largest producer in the market. And because of that, we have to design our strategy recognizing that there may be other factors, other behaviors from other competitors that may cause the future market dynamics to differ from our base assumptions. So we're trying to have a diversified strategy, and whether that's by pricing structure, tenors, counterparty, or other factors that would allow us to deliver robust results in multiple future scenarios. And Jimmy, maybe I just add further on the market position, some elements that I think make our proposition attractive and why we've been welcomed by utility customers. When we think about who's bringing new sources of supply to the market to meet this growing demand, it really does rest on the shoulders of the new producers. The incumbent producers have been clear that growth is not a priority. And so the growth comes from the emerging producers. But Denison, within that set, is viewed as a low risk alternative. We have multiple sources of supply that we're offering. We have 1.85 million pounds of uranium in inventory that's de-risked, active production from McLean, all in advance of our Phoenix asset, which is scheduled to be online in mid-28. So having that variety, diversification of sources has really been a key differentiator and something that's been really well received by utilities.
And Geoff, in the past, Denison has held a large inventory of physical uranium on its balance sheet. Do you still own that? And if so, how much?
Yeah, thanks. So we do continue to own a large inventory balance that consists of 1.7 million pounds of purchased uranium. And we've been continuing to then build on that with the production we're receiving from McLean North production. So as of December 31, we have received approximately 150,000 pounds of uranium finished goods in inventory. So at the end of the year, we ended with 1.85 million pounds. Those will be used to support project financing objectives. Uh, with the multiple sources of supply, we're able to begin entering into long-term contracts with near-term deliveries, as well as pursuing more opportunistic transactions to provide cash flow and funding during the Phoenix construction time period.
David, let's bring the conversation back to you and discuss your second project, and that's Griffin. And this is going to be a traditional underground mine, unlike Phoenix, which is going to be ISR. What's the timeline or sequencing of Griffin in relation to Phoenix?
Yeah, Jimmy, certainly more to come on Griffin on our end, and you'll see from our plans for 2026 that we're going to be looking back at our pre-feasibility study work there, carrying out some additional evaluations, and working on refining that timeline. But the objective is to be able to utilize the cash flows generated from Phoenix to build the Griffin mine and to have the Griffin mine potentially in production before the end of the Phoenix mine, such that together we can have something that looks more like a 16, 17, 18-year mine life, producing over 100 million pounds in total. And again, using those Phoenix cash flows and our existing site infrastructure to be able to support the development of Griffin.
And David, the last CapEx number, according to the feasibility study we saw in 2023, was 737 million. Can you fund that entire number with the cash flow from Phoenix?
Yeah, the expectation is that we can. Phoenix has incredibly strong economics and operating margins, even with the prospect of repaying debt or the plan to repay debt ahead of that. With a roughly 4-year expected construction timeline for Griffin, Phoenix production should certainly be producing more than enough cash flow to be able to fund Griffin internally.
And you and your team are going to be very busy moving toward production at Phoenix and also moving Griffin forward. Do you have the skilled labor to do so?
Well, we've built up an internal team of engineering and technical experts. We are relying on a third-party construction management firm, which was announced earlier this year. We're using a company called Wood. They're involved in global engineering and EPCM-related projects across the resource sector. So they certainly add that extra capacity for us to be able to manage construction projects. And what we have is an integrated project team approach where we have great continuity on the projects from our teams that have seen the engineering through together with Wood, and then we're able to leverage Wood's talent set and team to be able to hit these peaks of activity. Now, in terms of actual construction workforce, we're using a variety of construction firms and vendors that are based in Saskatchewan and Western Canada, and they draw upon existing labor pools. I would say that the Phoenix project generally has a lower number of employees associated with it for operations and construction, owing to the nature of the project. And so the timing of that now is working out fine. As we move to Griffin, you would expect that you see with an underground mine potentially larger headcount, but that is yet several years away from being in production, and I think the workforce will have time to respond. Saskatchewan is a tricky market for that. It's not a big province, but it is centrally located. And it has shown that large projects can be executed in the province, sometimes drawing on Canadian resources from outside of the province.
David, let's move on now and discuss your balance sheet and how much cash do you have on hand and how will you allocate that cash in the coming year?
And we ended the 2025 year with just under $700 million in a combination of cash, equivalents, the physical uranium, and our investments. So that puts us in an incredibly strong position to execute on Phoenix. Our budget for the year does show a significant portion of our spend will be going to support the first year of construction at Phoenix. But we do also have budget for continued exploration as well as evaluation work, as we talked about, to bring Griffin forward and to be able to advance that project. So a balanced but focused approach. Our priority is executing on Phoenix, and the budget shows that. But we do see the importance in this part of the market cycle to be investing in assets for growth as well.
And David, Denison also owns several equity positions in various uranium companies. What are your intentions with these companies?
And we've built up what we call Team Denison of equity and investment positions in companies that are exploring in the Athabasca Basin region with us. These are junior companies. Look, making a discovery in the Athabasca Basin region of a meaningful uranium deposit is actually quite challenging. And so while our focus is on executing at Phoenix, and we will be exploring, I call it domestically within our own portfolio on top priority projects, we like the idea of amplifying our exposure to discovery success by investing in and partnering with good quality juniors. And so the strategy here has been either to take non-core assets and vend them into or partner with companies, like in the case of Cosa Resources or Foremost Clean Energy, where we have a 30% interest at the asset level, plus, I guess on top of that, a large equity position, roughly, in the range of up to 20% in either of those companies. So really strong partnership there, but allowing those companies to raise the capital, use their teams to explore assets that we were unlikely to be exploring in the next 3 to 5 years. And we also have a great partnership with Sky Harbor Resources, where we've been a long-term shareholder, but recently announced a transaction where a very large property called Russell Lake, which is adjacent to the north and the east of our Wheeler River property, has been broken up into 4 different joint ventures, where we have initial interests in those joint ventures. And importantly, we have the option to earn into up to 70% on 2 of the key joint ventures. And the one that we're focused on right away is called Wheeler North. Obviously, some potential synergies if a discovery is made on Wheeler North with our Phoenix and Griffin deposits on the Wheeler River property. So really trying to be able to keep that growth profile moving and portfolio active, because we do believe our company would benefit significantly from exposure to another significant discovery in the region.
And when I hear you talk about these various projects, one thing that really comes to mind is, and I don't think a lot of people realize this, but just how large the Athabasca Basin is. And so much of it, the vast majority of it, is not unexplored.
There's a mix of intensities of exploration. You're right. I mean, there's a lot of the region that hasn't been explored. Some parts of the region where there's known mineralization has had, a lot of activity. What I like about it, Jimmy, is that we're tapping into multiple teams, because exploration is not just about good quality land. And I think we've got in these companies, we've got better than average land positions, mostly coming from Denison, having been in the region a very long time. But now we've got smart minds at Denison, smart minds at Cosa, Foremost, and Sky Harbor, all working on making a discovery. And I think that's potentially very powerful. I look at recent results from Cosa Resources, where they've had success on the Murphy Lake North property. And of course, we hope that will be something that turns into a meaningful discovery. But it's really accessing all these thinkers at the same time, and being able to work such a vast portfolio of property without us diverting our focus from executing on Phoenix.
David and Geoff, that was a great update, and I want to thank you very much for spending time with us today. And as we wrap up, what news flow can investors expect from Denison in the coming months?
Jimmy, this is an incredible platform as always, and you've put together an excellent lineup for this conference, so we appreciate being part of it. We do have an active next 12 and 24 months ahead for our company. Obviously, we will be focusing on construction updates for Phoenix, but certainly you'll see us talking about the work that we're doing at the Griffin deposit, as well as our work across the exploration development portfolio and Team Denison. And then on Geoff's side, certainly more to come, as you already heard about our commercial activities, contracts under negotiation, and we know that the investors are very interested to see how our commercial book is coming together. So I'd certainly stay tuned for that as well.
David and Geoff, once again, thank you.
Yeah, thank you.
Jim.
Hi, it's Jimmy, and I hope all is well with you. Before we get on with the interview, one small request. Please follow me on Spotify and Apple Podcast. Leave a rating, leave a comment. And if you have any suggestions on who you would like to see interviewed on the channel, let us know in the comment section. Thank you for your support. Now let's get on with that interview. Phil, thank you very much for joining us today. A lot has happened at IsoEnergy since we last spoke, including the acquisition of Toro Energy. You also did a capital raise that was very well received. And before we discuss these events, why don't we just start with a brief overview of IsoEnergy for those investors who might not be familiar with the company?
Yeah, thanks. And great to be here. That's a great place to start. First thing you need to know about IsoEnergy is we're a growth-oriented, diversified uranium company focused in the top tier jurisdictions in the world, being Canada, the United States, and Australia. We trade on the TSX, ticker is ISO, and on the New York Stock Exchange under the ticker ISOU. We are a company with good scale. We've got approximately a 900 million market cap, and post the acquisition of Toro, we'll have over 400 million pounds of uranium across the various projects in our portfolio. And in the portfolio, we have a good project breadth. So we have projects at many different stages of development, from near-term production, advanced exploration, and we have a number of very interesting call option projects, very large, very high-grade projects around the world, which we think have tremendous upside, and a very big exploration portfolio. We think we're very well positioned to capitalize on what are very strong macro tailwinds for this industry, big supply deficit coming, and we have many projects that can fill that deficit. The last thing I think people should know about our company, we're extremely well backed. The company was originally founded by NexGen Energy. They remain our largest shareholder with 30% interest in the company and 3 members of our board of directors. And we're also very well held institutionally, including in many of the larger uranium ETFs that many of you, the viewers, would be familiar with.
That's a great overview. So let's take a look at your portfolio in more detail. And I want to focus on those assets which are really going to result in some higher valuation going forward. I want to begin with Tony M. Tony M was a past producing uranium mine in the state of Utah. And as you mentioned, you are moving toward production. Maybe you can just tell us what exactly you have to do to put Tony M into production.
Sure. Yeah. So you're right. Tony M is our flagship asset in terms of getting back into production. Past producing mine, as you pointed out, in Utah, which is a tremendous jurisdiction. Lots of uranium has been mined there historically, including out of the Tony M deposit. So it's been mined twice in its lifetime. And what that means is there's a tremendous amount of infrastructure already in place for restarting the project, and also the permits are in place. So that's all very good, and it means that we can move the project ahead very quickly. What we're doing right now is executing a bulk sample, which will provide us valuable information to make the decision to restart the mining, including economic information, technical information about mining grades and thicknesses, processing information, cost, etc. All of that information will be fed into an updated technical study, which we intend to have released sort of mid-year or early second half of the year. And the results of that study will give us all the information that we need to make a go or no-go decision with respect to production restart.
Okay, and then you would make that decision before year end?
That's the goal. I mean, of course, it will be subject to market conditions at the time, where we see the uranium price, where we see the outlook for the price. We are, we will be. The whole goal with this project is to be ready to make that decision, but we're not in any rush to make the decision. We want to maximize the value of the uranium in that project. We know we can bring it on very, very quickly and take advantage of what we expect to be a very strong uranium pricing environment.
And Phil, is it too early to determine how many pounds Tony M will be producing on an annual basis?
I mean, look, we look at it 2 ways. We look at what it did historically, So maybe for context, we should tell the audience the number of pounds we have. So we have 8.8 million pounds in a resource that was put out in 2022, both in the indicated and inferred category. We're very confident in that resource. There's over 1.5 million feet of drilling into the deposit. So we're very comfortable with the pounds of uranium. Historically, when the mine was in production, if you annualize the production rate, you would get something between 500,000 or 750,000 pounds of uranium produced per annum, again, based on historic run rates. We think that based on the size of the resource and what we see, that's a pretty reasonable level to get back to. And so that's the range that I would guide the market to. Let us get the information out to the market in terms of the technical report, and that will tell you exactly the rate that we expect it to go to. Of course, there will be a ramp up when we start the mine again. So we won't get straight to those numbers, but over time, we think it's a 6 to 12 month ramp up. We'll be able to achieve similar production levels to what they did in the past.
Phil, let's move on now. Another asset I want to discuss is Laroque East, and this is located in the Athabascan Basin. And this is where the Hurricane deposit is, which is the highest uranium grade deposit in the world. And you recently commenced a drilling program. Why don't you tell us about the drilling program, what your targets are, how many rigs you have in place, and how many meters do you want to drill?
Sure. Maybe before I do, I would mind just telling you a bit more about the deposit. You correctly highlight that it's the highest grade published uranium resource in the world. And what we're talking about is we have 48.6 million pounds at 34.5% grade in the indicated category. 34.5% grade, just to put it into context, is twice the grade of the current highest grade producing mines in the world, which are also in the Athabasca Basin. And it's a massive order of magnitude higher than the average resource grade in the world, which would be less than 0.1%. So that's what it's got going for it on the grade side. It's also got good scale. There's over 50 million pounds in the resource, both in the indicated and inferred category. There's a tremendous amount of infrastructure in the region. It's located 40 kilometers away from a currently operating mill, the McLean Lake Mill. The deposit itself is relatively shallow at 325 meters below surface, and it's not covered by water. So, and the mineralization, the tenor of the mineralization, it's quite thick in places, up to 12 meters thick. And we think there's a tremendous potential for expansion. So to get to the question that you asked, we are currently in just finishing up a winter drill program. We started out with the goal of drilling 13 holes, 5,200 meters. We ended up doing a bit more than that. I think we got to about 17 holes, both because productivity rates of our drill crew were great this winter, but also because we got onto some very encouraging areas that we wanted to continue to test. Results from those programs will be out in a couple of weeks. What I can tell you, though, in terms of what we were targeting is really there's really two scales of exploration that's happening on the project, and this has been happening for the last couple of seasons. It's about trying to grow the resources in and around Hurricane, and we've been testing extensions to the ore body on what we call the north, south, and main trends. Again, results from this winter's program will come out in a couple of weeks. The second part of the exploration campaign is more regionally. What we have is as a very concentrated ore body right at the western side of our property border. As we go east, we have a continuation of the prospective conductor corridor that goes 9-10 kilometers on our 100% owned property, and we see many different areas where there's potential to find additional deposits like Hurricane. One of those areas specifically, which we call Area D, we've been following up on, where we drilled in a previous campaign a hole over 1%, which was the best hole that we've ever drilled on the property outside of Hurricane. So we've been following up there as well.
And I think it's worth mentioning that Hurricane also borders on a project which is jointly owned by Cameco and Orano, and it's called Dawn Lake. They've also been drilling. Do we know the results?
So we haven't, and those results have not been published. So we're all in the same position in terms of understanding, other than in some recent financial statements, Cameco did make reference to the exploration program. It's the largest exploration program on any property that Cameco has. And they basically said the nature of the results that they're getting looks like other mines in the Athabasca Basin. We know because our deposit is effectively runs right across the border, they're getting the continuation of Hurricane. And it sounds very encouraging what they're saying in their disclosure, and just what we're seeing on the ground in terms of the level of activity, the number of drill rigs, the number of people, the size of the camp, et cetera. From what we see across the border, they're onto something very substantial, similar to what we have, and maybe better.
And Cigar Lake Mine is slowly depleting over the next 10 years, and Cameco will need ore to feed the McLean Lake mill. Maybe you can just speak to that and how maybe a combination of Dawn Lake and also Hurricane might help fix that problem or alleviate that issue.
Yeah, look, it's no secret Cigar Lake will run out of ore. This is disclosure from Cameco as they go into the extension zone. There is a limited mine life, and that's just like every other deposit in the world. It's not a knock against Cigar Lake in any regard. It's a tremendous ore body, and it's been a great mine for them. But it will come to an end, and that will be 2035 will be the last year of full production, and we'll at 18 million pounds, and it will ramp down from there. And so replacement for that production will be required, and a replacement for the mill will be required. We think that Hurricane, and as you point out, and probably in combination with Dawn Lake, is absolutely a tremendous potential replacement for Cigar Lake. Partially, may not be the full replacement. There are other deposits in the area that could also be turned on and fill that gap that is absolutely coming when Cigar Lake runs out. But from our analysis, we don't see that any of those other projects have the scale or the grade that compares to Hurricane and Hurricane plus Dawn Lake. So we think it's a natural fit that this area, that a mine gets built in this area, again, to replace the depleting Cigar Lake mine.
So we talked about some of your assets in the US and also in Canada. We're going to move to Australia now. In 2025, ISO acquired Toro Energy, which owns an asset called Wailuna. That's a uranium project. It's located in Western Australia, and there's a ban on uranium mining in Western Australia. This asset why you wanted to acquire it?
Yeah, so just a few points to your intro there. We announced the acquisition of Toro last year, 2025. It hasn't closed yet. It's scheduled to close in Q2 of 2026. I think I'll just take a small exception to the ban on uranium mining. I think that what we're dealing with in Western Australia is a policy against uranium mining by one of the parties. In particular, it's the party in power today. What we like about Toro, by the way, and we think the bigger story of uranium, I touched on it at the beginning, is that uranium demand is going to double by 2040. And there are not enough known deposits around the world to fill that demand. So what we've done in our diversified portfolio approach is look at areas that have great deposits and are great mining jurisdictions, but have historic impediments to development where we think there will be an opportunity for those impediments to be overturned, because it's imperative that we get these uranium resources out of the ground. Western Australia is one of those jurisdictions because, first of all, Australia as a whole, amazing mining jurisdiction. Western Australia, tremendous mining jurisdiction. This deposit sits in the Wailuna area, in the northern goldfields, surrounded by gold mines, nickel mines, lithium mines, iron ore mines. Tremendous amount of infrastructure. It's a mining jurisdiction. This deposit itself, very good development characteristics, sits very close to surface. A number of economic studies have been published in the past showing robust economics, and that this mine this mine should go forward and be a mine to fill that supply gap. Historically, the project has been fully permitted, both by the state government and the federal government. So there's a pathway to permitting again. And I think that for the price that we're paying, Toro on its own was struggling to get a lot of traction, and it was difficult to credibly advance the project. I think that under our umbrella, with projects that are firing in America, in Canada going into the Western Australia government and suggesting that we would be a good steward of the project, I think is absolutely true. And I think we'll get quite a lot of support for that, particularly as time passes, uranium prices increase, and the necessity of bringing on new deposits to fill that looming massive supply gap come. This is one of those projects that we absolutely think is going to be turned on, and we're the company to do it.
And so what are the next steps at Wailuna?
So the next step really, so it's close the acquisition. It's called the shareholder meeting, the Toro shareholder meeting, close the acquisition. And then our first plans are really technical work programs involving a pilot plant to demonstrate some of the beneficiation work that Toro has done on the deposit, infill drilling campaign, update both the resource into a 43-101 format and the economic study, transition it from a scoping study to a PEA, again, 43-101 compliant, and we'll roll those programs out over the next 12 to 18 months post-acquisition.
Phil, IsoEnergy owns a number of deposits which have a lot of optionality, one of which is Coles Hill, that's located in the state of Virginia. Can you speak to the potential with this asset?
Sure. Coles Hill, again, another very interesting call option is what we call it, of course. It's the largest uranium resource in the United States. And this is important. So it has 160 million pounds of uranium. It's in the historic category, was drilled to 43-101 standards by the previous owner. Once we acquired it, we have to consider those resources historic. Very large deposit. It sits in Virginia. Virginia is a very interesting jurisdiction. It does have a history of mining, particularly coal mining, but not of uranium mining. It has a number of nuclear power plants, 4 plants in the country, in the state today, and plans to add new nuclear power. There's a massive data center infrastructure in Virginia. In fact, it's the jurisdiction with the largest number of data centers of any place in the world. So incredibly power hungry. But because it had no history of uranium mining, after the deposit was discovered, the state put a moratorium on uranium mining. It put it into law until such time that rules and regulations were put in place to regulate uranium mining. Those rules haven't been adopted to this point. We think now is the perfect time to advance this project and get those rules put in place. You have, what we've talked about is a global supply crunch coming, but it's exacerbated even more in the United States itself, where you have the largest number of nuclear power plants. So the biggest demand per annum for uranium is in the United States, and very low domestic production. That does not sit right with this administration. I think everybody's been following the push for critical mineral development within the United States, onshoring that production. And there's no project in the country that can provide the kind of annual production rate that Coles Hill can. So we're putting effort into both lobbying, both in the federal government and in the state government, to get support for removing the moratorium, putting those regulations in place. And in the background, we're updating all the technical reports that relate to the project. And we think now is the time. The tailwinds are fantastic for a project like this, and it's finally starting to get the recognition that it deserves.
And to your point, the U.S. consumes 45 to 50 million pounds of uranium annually, but they produce very little. So it's just a matter of time, I would think, before the U.S. administration starts moving projects like this forward.
We completely agree, and we're seeing it already in other states. Some of our peers are getting support for advancing the permitting on their projects. There's various programs to accelerate permitting timeframes, and so that support is there. We're getting a lot of it of course, for our Utah projects, and we expect to get it for the Coles Hill project. It's just a matter of time, in our opinion.
Now, ISO owns several equity positions in other companies. What are you hoping to achieve with these investments?
Yeah, look, the equity positions do a few things for us. The first thing, we generated most of those equity positions by vending non-core assets out into other companies. And so we took projects that didn't fit our model and put them into hands of companies that it does fit their model. And so it reduced the resources that we needed to dedicate to those projects in terms of human capital and financial capital, but while retaining upside exposure to those projects and those teams and those companies that we got involved with. And ultimately, we look at it very similar to what we see in large gold companies. Agnico Eagle, for example, has a very large equity portfolio, and it gives us a bit of a chip in those companies. And ultimately, if the projects that they're working on develop to the level that it makes sense for us, and as you know, we've been very acquisitive in our history in terms of building this portfolio. If some of those projects start to fit the bill or look like they're going to fit the bill, maybe we bring them back in, or it becomes a source of liquidity for the business going forward. But for now, we're very happy with the positions that we have. We think there's tremendous torque and upside in those names as we enter a real proper bull market for uranium. It's the juniors that sort of participate last. We've seen good moves in the larger companies. Those smaller companies, we expect them to get attention going forward, and we've got a really nice exposure to that.
Phil, let's discuss your balance sheet now. You recently did an equity raise. It was very well received. You wanted to raise 50, but you ended up raising significantly more. Can you just speak to that? And maybe you can also speak to the nature of the buyers.
Yeah, I think that's a really good question because, as you say, we went out to raise 50. We ended up raising 57 and a half. I can tell you that the demand was an order of magnitude larger in terms of what institutional investors wanted to put in versus what we took. I mean, we took 15% more than we went out for, which is a pretty standard increase using what's called the green shoe. But we could have taken a lot more. We didn't need those funds, but it just tells you the sort of level of interest there are for companies of our nature, our company in particular, of course, but from institutional investors all around the world. The complexion of the book, there were about 45 different institutions that participated all over the world, and some of the size of orders were pretty significant, including one order that was the entire deal size.
And Phil, maybe you can speak to use of proceeds.
Yeah, look, it's really it's everything that we talked about today. We're poised and ready to go into production in the U.S. with Tony M to start when the market conditions are right and we have the technical information back. We're now funded to do that. In Canada, we had a very successful exploration program this winter. We intend to follow that up with aggressive programs in the summer and the following winter. We're funded for that. Exploration in the United States is going to become more interesting, more relevant, more important, and we have tremendous potential in the portfolio in the United States, beyond just, hey, we can turn mines back on. We can find more resources to feed those mines for many years to come. We're going to execute that exploration program, and we're funded for that. The Toro acquisition, once that completes, and the programs that I mentioned in terms of what we're going to do to advance those assets, we're funded for that. We're funded for all of the things that I've just discussed and beyond. So I feel like we are probably in one of the strongest positions of a company in our stage financially. So very, very happy with where we are and excited to execute on all of those plans.
Phil, I want to look at IsoEnergy from a valuation point of view. As you mentioned earlier, your market cap's around 900 million Canadian, but you own many assets that aren't really achieving any value at all. And I think you would agree with me when most of that value is probably associated with Hurricane and maybe Tony M. Is that a fair assessment?
Yeah, 100%. Yep.
And so how do you unlock, or how do you get the market excited about the other assets that you hold in your portfolio?
Yeah, look, I mean, so to talk about valuation just off the start, like, we are very well covered by research analysts, buy side or sell side research analysts in Canada. Target prices range from $18 to $28. So in terms of where people see the value of our company going forward, that's kind of the range. How we unlock that value, I mean, I think it's advancing the assets. It's showing the pathways, showing that we can move these assets forward. The way that we talk about it is we talk about advance, enhance, and de-risk. How do we advance the assets, enhance the value of the assets, and de-risk them? Those are all the programs that we're talking about. We think do that, and ultimately, we believe the market will pay attention to that. If they don't, I think that if the sum of the parts is greater than the whole, and we're continue to trade at a discount relative to the value of the individual assets, I think that we've shown, based on our track record of M&A, both acquiring assets accretively, but divesting assets to get positions in other companies. I think we'll be able to navigate, the right paths to realize value from some of those assets that, as you say, might not be getting the value reflected in our market cap today. So we're alive to this question, and every day we think about how do we maximize the value of the individual assets and the company as a whole.
Well, Phil, this has been a great update and a great overview of ISO Energy. And as we wrap up, you've already provided us with a lot of details on what you and your team will be working on in the coming months. But maybe you can just summarize for investors what they can expect in terms of news flow here in the next few months.
Yeah, look, I think it's going to be a very busy year on the news flow front. It's exploration results primarily out of Canada, both Hurricane, but our other projects as well. And development milestones at Tony M in terms of getting those technical studies out to the market and making that restart decision. Exploration in the US as well. We'll start up again in earnest in a couple of weeks. A stream of results from there, and then the Toro acquisition. That's going to be a big milestone for us in Q2. I think that ISO just is one of the few companies out there that offers investors a diversified exposure to the uranium sector in the best jurisdictions in the world, with projects firing at multiple stages of development and catalysts across the board.
Well, it sounds like you and your team are going to be very busy. So once again, Phil, thank you.
Thank you. Always great to talk.
Pierre, thank you very much for joining us today. Before we begin with an overview of what's happening within the uranium market, why don't you give us a brief overview of your firm, WMC?
Hey, Jimmy, great to see you again, and nice to be on. It's been a little while. So WMC, we're a Dutch commodity merchant, moving our head office to Switzerland here, in the process of doing so anyway. And we're mostly active in the nuclear fuel market, but now we also have a fairly substantial team in the battery metal space, so lithium, nickel, cobalt, manganese, doing a little bit of stuff in copper, and also looking at rare earths. So the team is growing quite fast, both the nuclear team and the rest of the team as well. But things are going very well. It's exciting. It's a lot of exciting markets in general in the energy transition space. So no, we're full steam ahead. It's a great time.
How many people work at the firm now?
We're about 40. So it's like 40 and counting. So we obviously have a lot of sort of the finance department, legal department, and the communications and such. So now we're a proper company, so we also have the corporate functions as well. So.
And you trade uranium exclusively?
Yes, my role is uranium only. That's right. Yeah. Well, I mean, some conversion and enrichment we offer to utilities as well, but my particular job is almost 100% with Sprott.
So you're exactly the person I want to speak to, because we're going to talk all things uranium today, and you're on the front lines. And I want to get your views on the uranium market year to date. It's been relatively quiet. It topped out in January at $106 a pound. Now it's trading around $85 a pound. How would you describe the action year to date in the spot market?
Well, from a personal standpoint, it was anything but quiet early in the year. I think January, February was some of the busiest I've seen, and that's all obviously thanks to John and his team at Sprott, who raised a lot of money, or investors that put a lot of money into Sprott, and we bought over 5 million pounds. So I would say it really started in quite a ferocious pace. After that, when we stopped buying and sort of invested the money that was invested in spot. Then it's been a lot more quiet, and it's sort of the spot market has changed tone quite a bit. Obviously, the biggest buyers disappears, and then you still have some sellers. Naturally, you're going to see it drifting down. I wouldn't say there's been any panic selling from anyone, but when the equity markets have been the way they have, clearly there are going to be some investors who just throw their hands up and it's like we got to get out of this, and then obviously there's gonna be some spillover effect in the uranium market as well because they can have physical positions in uranium. So we have seen a little bit of that, but overall, I would say I think it's held up really well. So it's sure spots maybe down at 85 now from the high of 106. But what I look at is the term price. In my view, that's by far the most important indicator in the current times anyway. And as long as that's holding up, I see us trading in a band around that, and certainly it can break out of it depending on what the investors do. But overall, I would say, considering every other market is more or less on fire at this point, then the uranium is holding up quite nicely.
And why were you able to raise so much or so many pounds during January, February? You said 5 million pounds. Where did the supply come from?
I mean, that's, I'd say because, I mean, people saw the money flowing into spot. And then what tends to happen is that the sellers, like, I mean, I'm sure they have a lot of important things to do, but clearly one of the things they do a lot of is looking at how much money flows into spot. And when it does come in as much as it did, anyone who's selling is clearly gonna move their offers up. So we saw sort of an initial run from, I don't know where we started, if it was around 90 or so, and then we went into the triple digits quite quickly because there was a lot of capital flowing in. Then when that happens, then all of a sudden you find in a situation where the market is backwardated, so the spot price is higher than the forward price. And then what people tend to do is if they have a carry trade in place, they would basically just unwind that. So they sell in the spot market and at the same time make sure that they cover their now short position a little further out in time, well in advance of when they're delivering to their end customer. But considering you get a higher price up front and then you can just buy it back cheaper or at least flat out in time, then you're clearly making money on that. So that's where the absolute majority of the pounds that we were buying in the beginning of the year came from.
Interesting. So, in terms of producers, you saw very little supply coming out of producers?
Yeah, so far maybe we have one or two transactions with a producer. It's been 100,000 or so that one of these juniors that have a little bit to sell, but absolutely no major volumes at all.
And what about now? Now that the spot price is at, let's just say $85 for simplicity's sake, and you got term up at $90, are these carry traders coming alive at these levels or are they lower down?
I think they will in order to get a new carry trade in place, I think it would have to be a lower down in that case because you still have your cost of financing that is not that cheap. And if the term price, say, is at 90, and then by the time you deliver it a few years out, 95, but if you buy it at 85 today and at the same time, yeah, I mean, I don't know what your finance rate's going to be, 6, 7, 8%, depending on the creditworthiness of the counterparty. So it's hard to tell, but I would say it feels like it's a little still too high in the spot for carry trades to come in. But we saw some active buyers yesterday, over the last couple of days. So it was kind of down towards 83, certainly or 82 even for the chemical location, but now it bounced back up to 84 or something again. So it's you're starting to see that there's some kind of floor around there anyway.
Right. So below 85, that's where all the buying comes alive.
I mean, some of it anyway. It's like between 80 and 85, I would say that's where some buyers would step in for sure.
And is there much for sale between 85 and $90 a pound?
Yeah, I mean, I haven't tried. So sure, you can probably find 100 or 200,000 pounds at the current levels, and depending on how much you want to go after and what your time frame is. Yeah, it's hard to tell. But if you wanted to buy 1 million pounds, I'm sure it'd probably be high 80s at least. So
Yeah. So if you went out as an $85 buyer for 1 million right now, you would not be able to acquire that much?
no, I wouldn't say so.
Okay. I think it's safe to say we're in a risk-off environment right now. The S&P and the Nasdaq are down 5%, give or take. Gold is down 20%. Silver's down significantly more. So it looks like a lot of things have been for sale. Are these activities in the Middle East impacting the spot market or the term market from what you can tell?
I mean, nothing so far. Granted, it hasn't been going on for that long, at least not with the uranium lens on, which is where things are pretty glacial. But sure, there's been maybe some spot selling from investors in general who are just going risk off overall. So it seems like there's might have been some supply coming in there, and then obviously if they just want to offload it, they gotta wait for a buyer at some point sitting there, and if they're opportunistic buyer, they're gonna sit a couple of bucks lower, and eventually it sells. But I think that's the only thing we've seen in the spot. Certainly nothing in term, and I think. I mean, I had a couple of conversations with people over the last couple of weeks as, as things have unfolded in the Middle East. And I think the overall consensus is, if anything, it's probably a positive for uranium because it is stable source. You're not as, say, exposed to any supply chain challenges because you can have a reload sitting on site, or the first of all, the Middle East is not really a center for any of this. You don't have any production centers or any uranium kind of the Middle East, so it's not affected by that. So, I mean, hopefully it doesn't go on for this conflict doesn't go on for long, but suppose it is dragging out a little bit, it shouldn't affect the physical uranium in a negative aspect. Obviously, the way the Russian-Ukraine conflict, that has a much bigger impact on uranium, maybe not uranium itself, but conversion and enrichment. So that's a different story. But I think other than just creating very shaky equity markets, the conflict in the Middle East does not have a direct impact on uranium.
And are there any utilities involved in the spot market right now, like lower down? Are there utilities that are
There,
trying to
there was
buy?
some purchasing going on over the last couple of weeks. I saw them or heard rumors of some utility buying. No huge volumes because it hasn't been huge volumes overall, but definitely a couple three utilities that have been sitting on the sidelines, and they're not nimble enough. So when they see that something comes for sale at the location that they want it, at the level that they're happy with, they've been opportunistic and pick it up, and good for them. It's like I think they got a great deal on some material.
So let's talk about the term market now. And when you and I last spoke in September at the WNA, at that time, only 45 million pounds had been contracted. And then by December, that number increased to 116 million pounds, according to UxC. Were you surprised that so much had traded between September and December?
I mean, if I wouldn't have looked at anything and just seen in September 45, and then if I stuck my head in the ground and popped back up in January and someone would have told me 120, I mean, I would have been a little surprised, yes, because sure, transactions are pretty chunky, so and it depends on when they get reported, if they get reported. But the fact that it was so slow to begin with, it felt like there is clearly a lot of negotiations going on in the background, and you just don't know are they gonna be sort of reported this year or to 2025, or was it going to drag into 2026? And in that case, maybe it hasn't been reported yet. But I think where a big glut of material was, and the theory of this is that it came in basically November and December. So there was a big volumes reported November, December. And at least what some of the hypothesis is that you had this material extraction tax in Kazakhstan hit on January 1. So they wanted to get a lot of sales in place in order to not get a big tax hit. So there was a lot of contracting being concluded in November, December in order to avoid the higher tax level, essentially. It's like, again, I haven't confirmed that, so I also don't want to speak on behalf of Kazatomprom. Please ask them if they can say anything. But I think that there seemed to have been a fair bit of contracting coming out of Kazakhs anyway. So I think that at least could be a pretty substantial reason for the being increased. But overall, it's 116 is not replacement rates. So it's still not. 2025 more uranium was burnt than it was contracted. So that can't keep going forever. And if you look at where we're sitting this year, it's been a very, very slow start. And I think mainly in part because people have been distracted with the things that go on in the Middle East. So it's just it's a slow start. Most years tend to be a little slow because it also takes, a few months to get a contract signed, and then you got to report it and what have you. But yeah, these contracting levels can't go on forever. So at some point, there needs to be more contracting. Exactly when that happens, it's almost impossible to tell. But we have obviously seen that the windows that utilities are contracting for are moving into the 2030s now.
And so here we are at the end of Q1. How many pounds have been contracted?
I think just over 10 million pounds was the last I saw from UX anyway. So it's so very, very light. Not to
And
say that there can obviously be a lot of discussions happening, but it hasn't been signed and stamped and reported.
And earlier this year, we saw Cameco and Kazatomprom enter into long-term agreements with India. Any insights or any comments on those contracts?
No, I haven't seen like clearly it doesn't seem like those are reported yet, at least. So I would assume that there is some just contracting going on now. Maybe it won't be reported at all, but I would expect it to be. And clearly they were quite substantial. Otherwise, you wouldn't need the Kazakhs at an extraordinary board meeting. I mean, which means that it has to be a pretty sizable chunk. So I think it's great to see that India is buying. I mean, it's like they kind of everybody focuses on China all the time, and then it's like, oh, the Europe's going to build some new ones, and the US is quite slow. We got a couple of SMRs going on here, and like for some reason, India seems to be overlooked. And sure, they developing their own heavy water reactor technology that in theory can use thorium, and I think that's the end goal for them. But at this point, uranium is still not expensive enough that it warrants to spend billions and billions and try to develop a completely resilient thorium fuel cycle. So I think the Indians are doing exactly the right thing. They're building, in addition to some of their own design reactors, they're also building Western light water reactors where you use uranium, and they're contracting for it. So yeah, good for the Indians. They're doing exactly the right thing, and it was like that. And it's a good time to do it when the rest of the utilities are fairly quiet. This is a great time for them to probably get some pretty decent deals.
And maybe you can give us some color on what's being shopped out there right now in the term market, like in terms of RFPs, the size of the deals.
It's not a lot of them active right now. I think it's certainly no really enormous ones. I mean that's not what you see in the RFPs. If you're like, because the India deals will qualify as enormous, but most of the time when something is in an RFP, it's gonna between 2, 3, maybe up to 5, 6 million pounds. What tends to happen is also that the KHMP in Korea comes out every now and then, and they can be a little bit more sizable, up to 8, 9 million pounds, I think. And I believe they have to, like, it always tends to drag out because they have pretty strict restrictions on what they can do. So they have pre-approved levels, and then suppliers can bid into it, but they need to adhere to those levels. And when the market is moving, by the time the window for submitting an offer is closing, the market has moved away from the Koreans, so they get no compliant bids, and then everything starts over again. And that happened a couple of years ago, and it started to happen last fall. And I don't know if they managed to sort of get permission to do off-market discussions with the people that submitted the non-compliant offers. But I think that's the direction they're moving in, but we haven't seen any big volumes out of there. So that to me tends to be an indication, at least, that the contracts aren't signed yet.
And Pierre, what about floors and ceilings? Can you speak to that at all? What are you hearing?
I mean, I'm still, unfortunately, the only ones to do report anything is Cameco, and I wish more entities would. But from the last I heard, I think now its ceilings are up towards 150, and floors are going to be by 70, maybe creeping up towards 80. So it's clearly that it's been moving up, and it's been going nothing but in one direction too. So it's I'll have to. I know Grant is speaking at some conferences here shortly, so I'll have to dial in and see what he's saying, because he tends to be the best source of that.
What conference is that?
I think Goldman Sachs is having one fairly soon. It's more of a virtual thing, and then we have a conference here in Monaco actually in a few weeks' time, a fuel conference. So it's going to be great to have the nuclear fuel industry come to my backyard. So I look forward to welcoming them here. So
Oh, I might have to fly over there and attend.
yeah, it's going to be great.
Pierre, as we wrap up, are there any other insights you would like to share with our audience, just in terms of what's happening within the spot market or the term market?
No, I mean, as boring as it might sound, but it's like the uranium market is kind of boring right now. But considering everything else that's going on in the world, boring to me is not a bad thing. If the term price is holding at 90, I mean, it's the highest it's been for since the peak in 2007, 8. So in order to sit there, despite everything that goes on in the world, I think that's on very, very light volumes as well is actually a fairly healthy sign or a very healthy sign, I would say. And sure, the spot market's going to bounce around a little bit around that level, but the fact that it's like it's holding first, the term price is holding firm, and it's gone nothing but up for the last whatever we have here, 15 something years, and then the term prices or the spot price is dancing around that. To me, I see that as a healthy sign, and I am not worried. Sure, it's like I am worried what's going on in the Middle East, but I am not worried about the uranium market, and it's more patience than anything. So it's if people can just hold their heads cool, that it's not easy when everything is bouncing up and down or mostly down as things are now. But for uranium itself, certainly the term and the spot price for that matter is holding quite firm, and yeah, to me that's a good thing.
So you're still positive and still bullish on the price action?
I am still bullish, yes. I believe that towards as the year moves forward, the prices it will be higher than they are today.
Well, Pierre, this has been a great discussion, and I want to thank you very much for spending time with us today and sharing your thoughts.
Thanks a lot, Jimmy. Anytime. I look forward to next discussion as well.
Thank you. Leigh, thank you very much for joining us today. Today's discussion is going to be a little bit different from previous ones that we've had, because I always asked you in the past, when are you going to get your final permits? And now that you have them, congratulations. And I want to start right here. How long did the entire permitting process take, both at the provincial level and at the federal level?
Yeah, well, I'll start by, and thank you, Jimmy. I'll start by stating, look, we made the discovery in February 2014, and then had a number of resource upgrades. And with the feasibility study that we did in 2017, we then lodged the application or the original project description in April of 2019. And that really does officially kick off the permitting process, incorporating a lot of work that had dated back to 2011, frankly, in the area. The provincial permit we received in November of 2023, after we had secured impact benefit agreements with each of the identified communities in the local project area. And then the final federal approval, which you mentioned, was 2 weeks ago, on March the 5th of 2024. So it depends when you start the clock. I think April of 2019, once we had all of that baseline data and lodged the project description, is from a regulatory perspective is when it officially started. And so the whole process from a provincial level and also a federal level was just shy of 7 years in total.
And with this final permit, now you can start construction. Have you initiated applications for approvals of earthworks, shaft sinking equipment, mine waste facilities?
Yeah, it's a very good point. We started that process a couple of years ago, and so we're completely approved in order to start all earthworks, etc., at site. as we speak. And as we discussed on our previous catch-up, we've been expanding the accommodation at site to just under 600 hard-walled beds. With an exploration airstrip is under construction. It'll be ready in June, and then also upgrades to the road. So we have a construction-ready site as we speak. There is work going on as I speak. We will have an official launch date this coming summer. And it will be an excellent opportunity to reflect the contributions of everyone involved in the permitting process and particularly the community. Yeah, we are away and in construction as I speak.
And Leigh, does the final permit dictate what milestones you have to achieve within a certain time frame?
Yes, there is a time frame around the construction. Well, we'll be well within it. And look, that time frame though is basically a period to review the permit if you have not gone forward and constructed the project. But that's not applicable in this case. We are underway and aiming to be in production in 2030 as the schedule dictates. It's about a 48-month construction period, yeah, we're just so looking forward. We know exactly what we're building every single day over that 48-month period. We know who's responsible for it within NexGen and the consultants that we are using in order to construct the project. A benefit of a 7-year permitting timeline, Jimmy, allows you to review and review those plans. And so we're not chasing our tail, like what do we do now? This has been well thought out over the 7-year period. We have a very simple conventional mine in exceptionally sound ground conditions. It's a very small mine physically, and we've been planning it for 7 years. So we have full knowledge what we're building. We have the team in place. We've been preparing for 7 years, and it's just incredibly exciting for everyone involved, including our shareholders and stakeholders, the communities and the local government, for this project to finally start construction. Interestingly, one of the chiefs mentioned to me when I called him on the news of receiving the federal approval. He said people were tooting their horns in the street. So to hear that really did provide an incredible example of what it just does mean to the local communities, and what an incredible opportunity we have to show the rest of the world how to successfully develop a resources project.
And you mentioned that you're currently building a 600-man camp, so you're going to need a lot of people to build this mine, a lot of skilled people. Have you started this process yet, and have you encountered any issues getting skilled people to site?
Yeah, we have basically a split of about 1/3 technical skill, 2/3 requiring like technical college certificates. And we've been working with various provincial bodies or provincially sponsored bodies on training programs, both in the local project area and in Saskatoon. And those programs over the last 3 years have had incredible take-up and completion by local residents. We put out for 16 roles last month, and we received over 400 applicants. The month before that, we put out for 20 roles and received just under 400 applicants. So I hear labor is an issue with other projects, and it is. Again, I think what we're experiencing is the consequence of elite planning a long time ago and running in parallel to that permitting process. And so we're seeing the benefits of that pre-planning as we speak. It is a challenge, but it's one that we're aware of, and we've been on top of it for quite some time. And so the great opportunity for the local community is that there's never been a project in the local area of this magnitude. And so a lot of the skilled labor force has gone to Alberta predominantly. They now have the ability to come back and live and work in the area that they were born and raised. And so that's incredibly exciting for the local community, which is going to have an inflow of new residents as we construct and then operate this project.
And Leigh, I want to discuss the economics associated with Arrow now. When it's up and running, it's going to be the single largest producer of uranium in the world, producing up to 30 million pounds annually, which represents approximately 20% of global supply. But just for the benefit of these viewers who might not be so familiar with Arrow, maybe you can just touch on the economics and how profitable it will be when it's up and running.
Yeah, mine supply worldwide at the moment is at about 135 million pounds. We have been permitted to produce up to 30 million pounds per annum. So it's a large percentage of the world's mine supply, and if you put that into context, like Saudi Arabia is around 9% of the world's oil supply. So it's an incredible opportunity for NexGen and Canada. I mentioned earlier that it's actually physically a very small mine where we're only mining around 1,300 tons of ore a day. To put that in perspective, it's like 1.5 to 2 double-decker buses in terms of volume. So it's actually physically a very tiny mine. But why is that? It's a consequence of the grade and the concentration of the ore body. And as a consequence, or the result of that, is that we'll be at the current spot price, market price for uranium. It'll generate cash flows that will take the company into the top 10 mining companies worldwide on an after-tax cash flow basis. And that the payback period of the capex is just under 12 months at the current spot price. And so for those out there who reflect our assertion that we have we believe the uranium price is going significantly higher, when you look at the state of current world mine supply and the costs that are involved, the price has to rise. Simply, those economics get even better with a rising commodity price. And so NexGen is the world's most levered company to the market price of uranium in the future. And now we're fully permitted and about to realize it. And so for those out there who want exposure to a rising uranium price, NexGen is the world's most levered company to that scenario.
And Leigh, we also have to discuss your land package. It's 190,000 hectares, so it's massive, and you've only explored a small part of it. And in addition to Arrow, you've also made a new discovery. It's called the Patterson Corridor East, or PCE, and it's only 3.5 kilometers away from Arrow. You've come out with some drill results recently. Maybe you can just touch on that and what your plans are for PCE in the coming year.
Yeah, thank you, James. It's 190,000 hectares is a huge package, and look, we acquired it back in 2012, and it covers the edge of the basin of the Athabasca Basin. So conceptually, you're going to find deposits at their shallowest on the edge of the basin. we found Arrow, and just a brief history lesson for your new listeners. We found Arrow with the 21st drill hole ever drilled on the property, and the first hole within a 4.5 kilometer radius of any other drilling previously. And so when you consider the Arrow is the world standard of uranium mineralization, we clearly know what we're doing geologically, but to find it so early in such an expansive, underexplored area at the time really did defy the odds. We've now subsequently found PCE 3.5 kilometers away, also in the basement rock directly to the east, on a conductor which mirrors that of Arrow, and we've got thousands of those conductors, or cracks in the basement rock which hosts these deposits. We've got thousands of those cracks right throughout our land package. The prospectivity of the project it speaks for itself when you consider those factors, and I thoroughly believe when you consider Arrow, PCE, Patterson Lake South, which is off our property but along one of the same conductors, the mineralization that we've discovered in and around Arrow, something very significant occurred in that region from a mineralizing perspective. And I think we are in such, put it in baseball terms, we're still the first batter in the first innings of a 9 innings game when it comes to fully understanding the total mineralized disposition on our package. And so it's exciting, though. PCE is developing quickly. It's got all the same terrific attributes of Arrow. Who knows whether it's smaller, the same, or larger? Time will tell, because we're currently got 4 drill rigs drilling on it. But I think it's safe to say for anyone, whilst we'll put out a resource statement once we have a feel for the nature of that deposit. The federal government's talking about now expediting the approval of uranium projects in Saskatchewan. I think that's very exciting for our shareholders to know that whilst we're developing Arrow and constructing it, there's another phase 2 well underway, and we've got a really good head start on it as well. So watch that space. We've got terrific leverage to the uranium price with Arrow and the project that's approved, and we've got another one developing it which could completely change the economics of the company as we progress.
So as you mentioned, you're in the process of starting construction of Arrow. You're going to need a lot of cash to do this. So let's talk about your balance sheet and project financing. The CapEx is $1.5 billion. How will you fund this?
Yeah, $1.5 billion US. We currently have around $800 million US in the treasury. So we basically need that component again. And again, with the long permitting process, we've been working on the funding package of the project for many years now, and we're well funded for the next 2 years of construction as we speak. Basically, you can expect about a $200 million US spend in the first 12 months, and then it ramps up in year 2, 3, and 4. So we have time to conclude the balance of the funding. We have, the traditional sources of mining finance, which we're looking at. I'd say the convertible bond market is one of the most buoyant I've ever witnessed. So there's an opportunity as well. But we've been working on a number of finance packages which are pretty unique, and one of them is in the form of a prepayment on a future commitment of offtake. Which would be completely non-dilutive. And when you consider, $800 million US as approximately the target of the balance of the funding project, we could and the uranium long-term uranium price at the moment, or the 5-year price is $109. We're looking at a quantity of uranium which is less than 2% of the overall known resource at Arrow. That if we fixed it at that price and received a prepayment, it would completely round out the total funding requirement, whilst not impacting the leverage of the project to the future price of uranium. And so I'm just pointing out we have a number of options to conclude the funding project without compromising the economics or exposure to the future price of uranium. And it's a very unique position to be in. And as you know, James, we are all about optimizing every aspect of the project. And so those funding packages are improving as the uranium price is rising. And even as recently as we received final approval 2 weeks ago, new entities have come to the table wanting to finance that component of the build. So watch that space. It's not high on the risk register in terms of the overall project context, and we'll be concluding that in due course.
So we can expect a decision by in the first half of the year?
No, good. Look, I think we've got around 18 months to make that decision. And we'll make that decision when we're satisfied that we've secured the most optimal package possible.
So the last time we spoke was in London at the WNA, and at that time you entered into a number of contracts with utilities. I believe it was £10 million over 5 years. Has that number grown at all?
No, it's still at £10 million over 5 years. So it's £2 million per annum over that first 5-year period. To break even, we need around £3.5 million. And so we're almost there. There's over half a dozen contracts at I would say an advanced stage of negotiation. And now the permit's in place. I think you might see a few more of those offtake arrangements concluded. I will point out though, because we're already at a contracting stage, we're well covered for what we need in order to go into construction. So these contracts are going to be on a basis of really just setting some long-term relationships with the utilities that we're under negotiation with. Look, everyone's very clear, and I've been clear with our strategy. Our mandate is to have exposure to the future price of uranium due to what we read is happening in the marketplace. We have no interest in locking in prices at current prices with respect to the delivery of offtake. Our offtake will be completely tied to the market price of uranium at the time of delivery. And that's just so exciting for our investors and stakeholders alike, because that strategy does impact royalties paid to the government. It does affect the financial consequences to local communities, and we're looking to optimize every aspect of our project on every single front. So that is the basis of our strategy. It will always be that way, and it's exciting for everyone involved.
And you and your team are speaking to utilities on a regular basis. How would you characterize their mood at this time? Is it just business as usual, or do you think there's a sense of urgency starting to creep in? Are they concerned at all about supply?
I would say it's elevating for sure. Look, you've seen 2 transactions, I think, in the last 2 months, that Kazakhstan to China for around £20 million. You've then seen another one between Cameco and India for for around, I think it's 26 million pounds over 10 years. When the utilities see those types of transactions being concluded, it's taking substantial pounds that perhaps they thought were available off the market. And we're seeing in the news all the time new reactors being built, reactor lives being extended. The whole world, like the G7 tripling, and now countries outside the G7 also committing to tripling nuclear power by 2050. The demand scenario is incredible for nuclear, and yet the supply side, I would say, apart from ourselves and Denison, in terms, there's no new projects coming on board. And so the supply side is very fragile, and current production is forecast to come off substantially post 2030. So that is having a consequence on utilities' focus on long-term offtake, and I think you're going to see publicly some of the results of that elevation in the near future.
And I'm glad you brought that up about the supply, because a few years ago, when uranium price was significantly lower, $60 was the pound, where we thought we might see a lot of mines come online and we might start seeing some more supply come. But now we're well above that. What do you think the new number is for mines to be incentivized to start producing again?
Yeah, look, I think that $60 mark was a little bit of psychology, frankly, given where the price had been in the late 2015 through to 2020. Yet, the costs of production has been rising and well known for a long period of time. When I look at the economics of the current major producers, and when you look at the economics, it's just not raw cash cost. You've got to add in sustaining capex and the capex that's already been spent and amortized over the future periods, and that incentive price or cost profile of the major producers is approaching $70 US a pound when you look at the total cost. And so the price of uranium has to be considerably higher than that, considering the capital costs and the economic risk profile involved. I look at it also, I'm very technically and financially fact driven. When you look at history, well, the price of uranium in the mid 2000s went to $136 US a pound. At the time, the world had the top 5 mines at the time all had very long and healthy lives ahead of them. Only one of those mines is in production today. Now, of those other 4, Kazakhstan did replace it, but Kazakhstan's production profile does decrease quite quickly post 2030. And they've been very transparent with that production profile. So, looking at that technical and financial fact and data points, I think the uranium price will go significantly past $100 a pound US in the near future, and unless new supply comes on board, that price is going to go substantially higher. And I would just say between now and 2030, NexGen's 30 million pounds is not even going to replace what comes offline between now and 2030 on an annual basis. And so the opportunity for ourselves, Denison, and some of those projects which are trying to restart old mines is incredible. And that's with the assumption that the current producers keep producing the way they are somehow. But the fundamentals for uranium have never been more compelling and locked in a multi-decade scenario.
Well, Leigh, this has been a great update and a great overview, and I want to thank you for spending time with us today. And as we wrap up, maybe you can just summarize for investors what they can expect in terms of news flow here in the coming months from NexGen.
Sure. Well, on the ground, you're going to see the official construction commencement ceremony with local government and local communities. You're going to see an update on our offtake position, and all within a rising uranium price. As I said, for investors, NexGen is the world's most levered company to the future price of uranium, and we're in the tier one jurisdiction of Saskatchewan, Canada, with in a mining sense, a very sound ground conditions, with a very well-known mining method that's been proven and planned over many, many years. And we've built the team for this moment over the past 7 years. We know exactly what we're doing in a fantastic environment, and we are now bringing to the world, with the federal final approval process in place, what is going to be one of the world's most exciting resource projects, economically, socially, and for the citizens of Canada.
Well, Leigh, once again, thank you, and I'm looking forward to future updates.
Thank you, James. Look forward to providing them.
Hi, it's Jimmy, and I hope all is well with you. Before we get on with the interview, I have one small request. Follow me on Spotify and Apple Podcast, leave a rating, and leave a comment. And if you have any suggestions on who you would like to see interviewed on the channel, let us know in the comment section. Thanks for your support. Paul, thank you very much for joining us today. Why don't we start with a brief overview of Paladin Energy for those viewers who might not be familiar with the company?
Yeah, thanks, Jimmy. Look, Paladin is a multi-decade production and growth asset. You know, we have an operation in Namibia. We have a development project here in Saskatchewan in Canada, and we have a number of exploration projects globally, you know, in Labrador, but also in Australia. We're listed on the ASX and TSX, you know, I think we're here at a really fantastic time in the uranium price cycle.
So let's discuss your primary asset, Langer Heinrich, which is located in the country of Namibia. The mine is currently ramping up toward full production. How are things going with the ramp up?
Yeah, you know, as you said, Jimmy, we're in the final phases of our ramp up, and we expect to be completed around the middle of calendar year 2026. So since the restart of operations in March 24, Langer Heinrich has improved quarter on quarter, and I actually couldn't be more pleased with how things are going. Last quarter was extremely strong. We produced about 1.23 million pounds of U3O8, and that's a 16% increase on the previous quarter. And ramp up just keeps building momentum quarter after quarter. Our sales were about 1.43 million pounds at an average realised price of 71.80, and that reflects the quality of the contract book and, of course, the improving market conditions. Mining activity continues to ramp up as well, and that's giving us increased ore availability, and we're feeding directly into the crushers. So Langer Heinrich's performing really well as we move forward into full mining and production capability by the end of this financial year.
And Paul, at full production, how many pounds will you be producing, and what will be the production costs?
Yeah, look, we're going to put out guidance around July. What we're doing right now is continuing to conclude the ramp up, and in order to get there, we need to have our new mining fleet in place and fully operational. The plant is fully capable now of full production rates, and the mining fleet just needs to get to that full production. And together, they'll have the capacity to deliver those full rates. Now, our actual capability depends on three key factors, and that's the number of tonnes that we can put through the crusher, the grade of those tonnes, and the recovery out of the plant. And as we optimise our mine plan, we'll be able to narrow down on how that looks. Now, on a year-to-date basis, for the first half, we delivered about 2.3 million pounds of production. So that gives you a bit of an indication on what we're capable of during the ramp-up. And by the time we optimize the mine plan, we should be able to provide a really good insight into what next financial year looks like in terms of production and cost. At the moment, we're guiding on a 4 million to 4.4 million pounds of production and a cost of 44 to 48 US dollars per pound. The first half of the year, we came in at $40.50 per pound, so a little bit under. But for the remainder of the year, we have the increased cost of mining, and so we expect to see those costs come up into that the guided range, and we expect to see our production volumes towards the upper end of that guidance range as well.
And what are the targeted recovery rates and how are the recoveries?
Yeah, we target around 85 to 90% recovery rate. And that's really, really good for that style of deposit. For the last quarter, we averaged 91% recovery, which is extremely pleasing. And that reflects the quality of the work that's been done on site. We're blessed with a really capable team of people in Namibia, technically incredibly competent, great at problem solving and locking in these levels of performance. So 91% is an absolutely fantastic result for our team.
And as we both know, when it comes to mining, there's many complexities associated with it, and you can always run into challenges. But with this ramp up, maybe you can just touch on some of the challenges that you faced.
Yeah, I say to a lot of people, Jimmy, that mining is an outdoor sport, and all sorts of things can happen. And we did experience that during the ramp up. We started in March 24, and we've had challenges with water supply. But that was resolved quite quickly through collaboration between Paladin Energy, the Langer Heinrich team, and the Namibian government through their state-owned enterprise, NamWater. We've had issues with 1 in 50-year flood events. We've had stockpile grade issues of the stockpile that we inherited from previous management, and but we've managed to solve all of those problems. We've improved the quality of the water assets. We've supported the production of new pumping facilities for NamWater. We've increased the on-site capability, and we've reduced our water demand as well. So since we've solved those issues, probably November 24, we haven't had any water supply issues. The grade issues, that's behind us now. That was always going to be a transient issue as we depleted the initial stockpile before entering into mining. So that's gone. And of course, the recovery issues have been solved as well. And we're seeing this sort of slightly above target performance in recoveries. So yeah, look, all mining projects have challenges, but I'm really pleased to say it looks like we're sort of at the back end of all the ones that we've had.
Mining is a tough business. So I want to move on now and discuss your contract book. And now that you're a producer, you're going to get more aggressive with this, I can only imagine. But how many pounds have you contracted thus far and until what year?
Yeah, out to 2030, we've contracted about 23 million pounds of our production. Our team has put in place a contract book that I think is absolutely exceptional. So they've been layering in contracts in an increasing market. And every contract that we put in place is accretive in value. About 47% of the contract book is base escalated, and the remaining is market related. The base escalated contracts give us that downside protection in what is really quite a volatile spot market. But the market related pricing contracts give us that upside exposure to the high prices when they come along in that spot market.
And in terms of the fuel buyers, are they Americans, Europeans, Asians?
Yeah, we have about 14 different customers, and together they cover about more than half of the nuclear production capacity globally. We're exposed to European, Asian, and North American utilities.
And CNNC owns a 25% stake in Langer Heinrich, but they don't own any ownership in Paladin. Is that correct?
Yeah, that's absolutely correct. They're a partner at the Langer Heinrich mine, as you said, 25%. It's a really good relationship that we have with them. They have a lifetime offtake agreement. It's incredibly attractive. It's been signed back in 2014, and it's 100% market related, and it has no ceilings. It's a unique contract, and if we have additional capacity, then they're always willing to take more. So they're a good partner and a great customer.
So we're going to leave the west coast of Africa and move to Canada in the Athabasca Basin. And Paladin acquired Fission Uranium in late 2024. The primary project there is the Patterson Lake South, or PLS. And what is it about this asset? What made you want to acquire it?
If you're going to be in uranium, then the best postcode in the world is the Athabasca. And when this opportunity came up, our BD team ran the ruler across it, and there are so many things about it that are incredibly attractive. First of all, there's the size of the deposit, and we're currently sitting at about 93 million pounds of reserve, which enables us to have a 10-year life of mine at this point in time of about 9 million pounds per annum. But more importantly, there's significant growth potential in very close proximity to the PLS deposit. And it's got the infrastructure. It's a very supportive provincial government and federal government, and there's nothing overly complicated about mining at PLS. It's conventional in every way. So it's an incredibly exciting opportunity for us, and I'm really pleased that we were able to make that acquisition.
And what plans do you have for 2026 at PLS?
Yeah, right now we're working through the permitting process, and in the last couple of months we've been able to achieve our approval of the EIS from the provincial government. For the remainder of 2026, we'll continue to work on the permitting process with CNSC, and that's a very well-trodden pathway. More recently, other miners have been through that process and have received their license to construct. So that's the sort of pathway that we're moving down. We've been able to observe what other people have done and learn from their permitting process, and we'll apply those learnings to make that process as smooth as possible. So we'll continue also with updating engineering and just make sure that we're ready as soon as we get that permit to construct, that we can move into making the final investment decision before construction.
And do you have any drilling going on of any sort right now, or you're just going to focus on the permits?
No, we'll continue drilling. One of the fun things about Paladin Energy is that not only are we a current producer, we have a great project at PLS, but we're an explorer. We've been exploring for a long time, and we'll continue to explore. So at PLS right now, we've got 3 drill rigs, and we're looking at increasing the life of mine and the resource around PLS, but also in close proximity drilling, very, very close to the PLS deposit for future development opportunities.
So, Paul, let's move on and discuss your balance sheet now. How much cash do you have on hand, and how will you allocate it in the coming year?
Yeah, so as of December, we reported about 278 million cash on hand with an undrawn debt facility of $70 million. And so we're in great shape. Now, the deployment of capital is mostly dedicated towards the development of the PLS project, engineering, detailed engineering, early works, as well as long lead time procurement. And in addition to that, our exploration activities.
And Paul, as you mentioned previously, Paladin trades on both the ASX and the TSX. Do you have any plans for a US listing?
Yeah, look, I think we'll always consider options to increase investor access to our shares. But currently we believe that the ASX and TSX listing provides good access, and we see that reflected in the quality of our share registry. So at this point in time, we're not really planning on listing on the New York Stock Exchange for the time being.
And Paul, maybe you can just touch on your shareholder base. What % of your shareholders are based in North America? What % in Australia?
Yeah, so recently we had some shareholder analysis done, and it looks like about 43% North American, so America, Canada, just over 20% Australia, and the remainder are global, predominantly Asia and Europe.
Well, it's good to see you have some good support here in Canada and the US. So I want to touch on your marketing plans. You are based in Perth. You're currently in Saskatoon. Do you have any marketing plans coming up here in the coming months?
Yeah, we actually have a very comprehensive IR program for the year. It's covering North America, Asia, Australia, and Europe. We've just been to Hong Kong and Singapore last week, meeting with a large number of investors, and we've got some work to do in Australia and North America in May. Particularly following our release of the March 2026 quarter results just after 22nd of April.
Well, Paul, this has been a great overview of Paladin, and I've been looking forward to getting an update on the company. And as we wrap up, maybe you can just let shareholders know what they can expect in terms of news flow in the coming months from Paladin.
Yeah, thanks, Jimmy. Look, as I just mentioned, we'll release our March 26 quarterly results in late April, and that'll provide an update on the Langer Heinrich operations in particular. At PLS, we'll continue to progress the CNSC licensing process, as well as the exploration activities, and we'll update the market in due course. The next milestones after that are the full year results, and at the same time, we expect to release our guidance for the next financial year. So it's a really exciting year for us, and I really appreciate having the time to talk to you, Jimmy.
Well, thank you for being with us today. Did you know that 80% of our viewers are not subscribers to our channel? So be sure to subscribe to our channel, Bloor Street Capital, and also hit that thumbs up button and leave a comment below. Thank you for your support. Colin, thank you very much for joining us today. You and your team have been very busy since the last time we spoke. And before we do the deep dive on your various uranium assets, why don't you first provide us with a brief overview of Premier American Uranium for those viewers who might not be familiar with the company?
Yeah, sure thing, and great to be here. Premier American was born just over 2 years ago in recognition of the nuclear renaissance taking place globally. Specifically within the US, where energy security and self-sufficiency priorities were lining up with emerging greenhouse gas emissions mandates, to create an extremely robust environment for domestic uranium exploration, development, and ultimately production. This company was created to provide direct exposure to this theme with an acquire, explore, develop model that's seen us complete two major acquisitions since inception and become one of the largest uranium explorers in the U.S., focused on Wyoming. And at the same time, within our development pillar, rapidly accelerating development of our New Mexico project, where we deliver 2 mineral resources and a PEA in less than 2 years. So these two mandates are going to be a priority for us in 2026 as well.
So Colin, let's take a look at your most advanced project, and that's called Ciampaglia, and it's located in the state of New Mexico. When it's up and running, it will be utilizing both open pit and underground mining. A PEA was released along with an updated mineral resource. Can you take us through the highlights of this study, please?
Yeah, I sure can. The PEA and resource update for Ciampaglia was a major milestone for that project, really transformative as it moves from kind of exploration stage to development stage. That resource was our second within kind of a less than 24-month period. We increased our total resources by about 17% to 27.4 million pounds, 75% in the indicated category. That PEA, the preliminary economic assessment, released kind of fall of last year, scopes one of the largest single source uranium mines in the US, with average production of 1.4 million pounds per year over its 13-year mine life. Low development capital requirements of about 115 million US, and robust economics at $90 per pound uranium with an after-tax NPV of 84 million US, with major torque to uranium prices, where a $10 per pound increase in base case uranium price assumption increases our NPV by $70 million or 83%. So very exciting time for that project.
Colin, in your PEA, your base case for uranium recoveries was 80%, and this resulted in an NPV of $84 million. If you take your recoveries higher to the 90% level, what does this mean for the project and the economics?
Yeah, so it has a really, this was a preliminary economic assessment where we had not and have yet to complete advanced metallurgical test work. So it's a heap leach uranium recovery operation. We used an 80% recovery as our base case to be conservative. That is part of that base case MPV, 84 million after tax. But interestingly, with every 2% increase in uranium recovery that we assume, we get about 16 million in after-tax NPV out of the project. We see some analogs. There's a pre-feasibility study on another heap leach uranium project in the same kind of rocks that used a 91% recovery assumption following some advanced metallurgical test work, the same kind of test work that we're planning to conduct in 2026. So the goal in 2026 with the metallurgical test programs at Sabietta is to get that recovery assumption up. And the potential there is at 90% recovery, we're increasing that after-tax NAV by about $75 million to almost 160 million US after-tax NAV. So some fantastic potential to spend a not too expensive metallurgical test program to deliver what's potentially a 90% increase in after-tax NAV. So quite compelling and quite transformative for the project to really potentially improve those economics substantially.
And what are the next steps for this MET work, and what's the time frame associated with getting the results?
So the first step is that to perform what's this MET program is really long-term column leach tests. For a heap leach uranium operation, you have to perform these column leach tests to really refine your recovery assumption. So that's what we're going to do. We've already contracted the laboratory and the metallurgist who was responsible for the metallurgical test work on that PFS from another project that I mentioned. So we've got a really, really strong team managing that program in one of the biggest and best laboratories in the US. But we do have to drill first. We've already got the permits for the drilling, and we're just in the process as we speak of finalizing those drill contracts. So we expect to be drilling to recover the core that we need to feed those tests with representative samples. We expect to have that drilling underway in April. It won't take too long. It's only about 8 core holes required to get the mass that we need for those tests. And once we can deliver that material to the lab, it starts a fairly long test program because it's heap leach representative of about 42 weeks. So we're looking to complete that test program in early 2027. And then the potential to update the PEA would also be in the first quarter of 2027 with improved uranium recovery assumptions.
And Colin, when you're waiting on for those MET results, what else will you be doing at Sabietta?
Well, with the drill program itself, to recover the material we need for the MET program all that material is going to be assayed and characterized. So we'll be able to put out incremental results from that drilling, which will be largely confirmatory. It's right in the part of the representative part of the deposit that we want in that MET test work to properly inform new assumptions in the PEA. But we will have those results, which will be confirmatory, and there'll be bottle roll tests as well, which is another type of recovery test that can happen very quickly at the beginning of the test program. So there'll be some incremental news flow coming out of Sabietta as we move through the test program. But the big cherry on that is at the kind of end of the heap leach testing or column leach testing when we get that uranium price recovery information and potentially update the PEA.
Colin, let's move on to the state of Wyoming. The projects here are in situ or ISR projects, and the KC project is the most advanced. In 2025, you and your team drilled 132 holes totaling over 100,000 feet. What was the outcome of those drill results?
Well, the 2025 program was, deliberately designed to test continuity and geometry predicted in 2024 drilling and analysis. So results of that 2025 drilling confirmed that mineralization expanded along the expected trends, particularly across the eastern corridor, linking the Rustler and Stampede areas, which is on the eastern part of the property. And the most important outcome from that was the improved confidence in lateral and vertical continuity within the sandstone packages. So the trend between Rustler and Stampede areas is about 8 miles and shows continuity. So we're very encouraged about the resource potential along that trend. And then at the outpost area in 2025, we discovered a new uranium-bearing roll front system, which encountered some of the strongest grades in the 2025 program. So this is an earlier stage underexplored discovery at KC relative to Rustler and Stampede, and to that end represents a great potential upside for us, and we're excited about investigating that in a more targeted way in 2026.
And you planned another 100,000 feet of drilling. Why don't you speak to that, and what are your targets and where are you going to be focused?
Yeah, definitely. That 100,000 foot program is pretty aggressive, and as you might have guessed, with an 8 mile trend showing continuity of mineralization between Rustler and Stampede, that's going to be a significant focus of 2026 drilling. That trend's really transitioned from an early stage exploration kind of target to targeted drilling focused on increased drilling density to understand the scale of mineralization and identify deposits of scale kind of within that trend with an eye on resource delineation. And the secondary focus is going to be that outpost area. We saw some really good grade there in 2025, and we'll be looking to build on those results with drilling designed to define the geometry of that mineralization and apply the same kind of systematic approach to that's yielding results at Rustler and Stampede. So that 100,000 foot program is going to be generative of substantial news flow from kind of May, June until the end of 2026. And that's one of the ways that we're gonna really deliver news while we're working on some longer term stuff at Sebieta.
And the drilling season, is it going on right now, or does it go on all year round in Wyoming?
No, we're kind of weather constrained there, so we're looking at a May, June kind of start, depending on the weather. So we're kind of through the planning process in terms of proposed locations and targets, and we're just finalizing contracts with the driller for Casey as well. But we'd expect to kick that off in kind of the May, June timeframe.
The second project in Wyoming is the Cyclone project. You and your team initiated a drill campaign last year of 25 holes, and you recently released the results. What were the highlights of those results?
The Cyclone drilling was successful in 2025 on multiple fronts. This project is still early stage exploration, but continues to deliver intercepts above the generally accepted grade thickness and grade cutoffs for ISR resources in Wyoming. 2025 delivered the best hole ever drilled at Cyclone, 15.5 feet, grading 0.09% U3O8, including a high grade interval of 3 feet, grading 0.229%. So this really confirms the potential of that area to contain strongly mineralized occurrences. 13 of the 25 holes drilled there returned uranium mineralization of better than 0.01%, so fertile ground. And importantly for us, the program identified a new 1.5 mile trend mineralized corridor that remains open. So a great future target at that project. And that's additional to the 1/2 mile separate trend identified in 2024 drilling. So Cyclone Rim continues to be highly prospective in our view.
Colin, I want to move on now and discuss your balance sheet. You and your team recently did a $15 million raise. How did it go?
It went very, very well. We initially launched that bought deal financing targeting $10 million. We upsized to 15, and we didn't take everything that was on the table. I think $15 million really positions us incredibly well for 2026 exploration and development programs that I talked about. Well funded and still leaves us a strong balance sheet as we exit 2026. So there was robust interest in the offering at the time. Uranium prices have come down a little bit since we completed that offering. And obviously there's some other kind of noise in the markets right now, and I think that'll subside. And I think that we're going to have a very, very strong campaign in 2026.
And in terms of the investors who participated in that deal, how would you define them? Are they Americans, Canadians, retail, institutional?
Mostly institutional, some retail in a bought deal. We don't have the same insight into the book that you have in a broker private placement. But most important for Premier American Uranium is the anchor shareholders of the company. Sachem Cove owns 20%, founded by Mike Alkin and Tim Martolo, and continue to be strong supportive shareholders. And ISO Energy owns 10%, also participated in the financing. Mega Uranium, significant shareholder, also participated in the financing. So our key shareholders continue to be there to support the stock. I think it creates a shareholder register that's second to none for companies our size, and we're always incredibly encouraged by the support of our shareholders.
Colin, when it comes to mining, scale and size are very important for many reasons, and one of which is exposure to capital markets through ETFs. How do you get involved in ETFs?
I think scale is one of the main ways to increase your position in ETFs. I mean, that goes without saying. We kind of know how they're structured. We went through a transformation in 2025 with respect to ETFs with the restructuring of the URNM. Held more than 8% of our stock, but changed its free float market cap requirements, and 8 or 9 of the smaller uranium constituents there were removed from the ETF just based on mathematics. Our job is to scale and grow this company and work our way back into ETFs like the URNM. We are well held by the URNJ, which is the Sprott Junior Uranium Miners ETF, and that's helpful in maintaining beta to the sector, and as generalist money continues to flow into uranium because of the clear, robust fundamentals around this sector. I think that ETFs are going to continue to be an important part of how these uranium junior equities trade and what supports them. But we look forward to kind of executing on the things that we've outlined for 2026 that we think are going to generate the scale required to again be large enough to be included in those ETFs.
So it's just a matter of meeting your milestones, and that's going to result in a higher stock price, higher market cap, and hopefully inclusion into ETFs.
That's my job.
Colin, as we wrap up, what can investors expect in terms of news flow in the coming months?
I think very, very near term, as I said, we're in the process of finalizing the drill contract for the Sebieta work. With the finalization of that drilling, we're going to have the driller, the metallurgist, the lab, and we'll put out a press release kind of outlining the milestones of that test work, that long-term program, the scope, what we hope to accomplish, remind people of the potential for higher recoveries to dramatically impact the economics of that project. So we'll put that out in short order. Same thing with KC. We're in the final process of selecting the driller. We've kind of scoped the program, and we'll put out a press release ahead of the beginning of that program, kind of giving the scope of it and saying what we intend to do and going through some of the things that we just went through. And then pretty much right away, we start drilling at KC in kind of May, June timeframe, weather dependent. And that should start to generate news flow pretty quickly. And so we expect to have continuous news flow out of KC kind of from May, June until the end of the year. And at the same time, in the background, the longer term test work at Sebieta will have some news flow associated with it ahead of the big milestone at the end. So it should be a very newsy year for us.
Well, this has been a great overview and a great update on Premier American Uranium, and I want to thank you very much for spending time with us today.
Thank you very much. I appreciate it.
Mike, thank you very much for joining us today. How are things in New York?
They're you know what, Jimmy? They're not snowing, so that's good. It's been a snowy winter. I know talking to a Canadian, I probably shouldn't complain about winter, but it feels like a Canadian winter here.
Yes, well, as you know, I'm based in Toronto, and we've had a brutal winter. Typically, we don't get much snow, but this year, I'm sure it's similar to New York. So I can't believe here we are at the end of March. We're already Q1 is almost out of the way, but I want to start and get your assessment of the uranium market overall as it stands right now in 2026.
Fundamentally, as strong as we have seen it, sentimentality wise, it is like a yo-yo. it goes up and down and it turns on a dime, and oftentimes you don't know why it's done that. So it's since we've been involved since 2017, 2018, it's always a series of 2 steps forward, 1 step back. And so, we have seen a continued rise. The things we really focus on are the long-term contract market, and we've seen prices just continue to rise. And we focus on that because it's where the vast majority of pounds transact. And that sits today at $90 a pound. When you and I met many years ago, it was probably in the mid-20s to low 30s. And it continues to rise month after month after month. It goes up a couple of pounds. And that's just the fixed price contract, which is the only price reported technically by the price reporters. But if you look at where the market is transacting, the bulk of those long-term contracts are transacting in the collared market, where there are floors and ceilings. And because since there's no futures market to hedge, you see collars. Producers want floors, fuel buyers want ceilings. In that market, you're seeing for the big 800-pound gorillas, they could get $160 a pound on a ceiling, with floors in the mid 70s to 80, in that ballpark, mid 70s ish, with spot in the mid 80s. So very little downside, massive upside. On the asymmetry in that contract is very significant. And even for the smaller guys, you talk to some of the smaller producers or near producers, they can get 120s in the ceilings, and they have very little pounds to offer. So they're not a major player. They'll what the utilities use to kind of negotiate. But that negotiation has changed. It's the uranium producers are not price takers at the moment, right? They're price setters. So we've seen that. And then the spot market bounces around and is what people focus on, because that's the daily price that's reported every day, as ever. I'm sure most people listening to this will know that. And that moves around like the wind. It's a small market. It's an undercapitalized market. Most of it is traders. Very, very little utility buying, and utility is basically the only customer and for the end use. So it's just traders swapping pounds back and forth. A producer might pop in to get if they're having a little bit of an inventory challenge, and that will move around. But again, that's gone from $17 8 years ago. It's now sitting in the mid 80s. It's had a fits and starts. It burst up to 100, and then it will pull back, and then it's kind of stabilized in the mid 80s range. But that's on the prices. And what's driving the prices is the underlying supply demand. And on that front, supply is still is challenged. Costs are materially higher. I was just telling you before we went live this morning that Kazatomprom announced their earnings, the largest producer in the world with a 40% market share in Kazakhstan. Their all-in sustaining costs for a pound of uranium are going to be about $35 to $36. They're predicting for 2026 is what they're guiding towards, versus $30 last year. If you went back and looked at their original IPO documents in 2017 or 2018, and they laid out on all the future years what their prices would be, around this time they were supposed to be around $11 a pound. So it costs a lot to produce pound uranium. It's not as easy as people think. There's significant mining inflation. And they're the lowest cost of doing this. So there's significant, as we go back, Jimmy, and look out through 2035 to 2040, which is looking at mining, that's tomorrow. You're looking anywhere from 20 to 30% of global demand will be in a supply deficit. It's not there, and we could bring on the new projects that are coming. So supply is very challenged, and on the demand side, I certainly never saw the demand. We were modeling very modest demand, and now demand is coming out, whether it's, for big iron reactors, for the big 1 gigawatt reactors, 70 under construction, and country after country lining up to build new ones. That was not on my bingo card. And so that's put a significant uplift to demand. Your mid-single digit demand profile is reasonable. Versus when we started looking at this years ago, it wasn't even 1%. So And we don't really factor in at all artificial intelligence data center stuff or SMRs. So, we don't know how that will play out because that's on the come. What's not on the come are those 70 reactors under construction, and then those that already got approval and funding. So supply demand is very favorable if you're on the production side or the investing side of uranium.
Mike, just because you brought up Kazatomprom, you mentioned that last year their all-in sustaining cost was $30. In 2026 is going to be 35. Why the increase?
Sulfuric acid costs have increased. Sulfuric acid it's an interesting input. It's more than a quarter of their costs on the COGS side. It's something that is local. Sulfuric acid is very hard to transport. It comes over by rail or it's in country. They produce a lot of it in country. They use a little less than a couple million tons. The bulk of that comes from in country, and there's a shortage. And they've been building plant. They broke ground. They're trying to get a plant. They started to get a little bit of production from one. There's another that they're working on. It's a tricky country to get approvals and to get management to want to sign off on without getting into. It's a lot of challenge. It's very bureaucratic. So there is supply that can come online, but it's costly. And you then could import it by rail from China or Russia, and costs have just elevated. Just raw material costs across the globe have elevated. It doesn't help with the Middle Eastern war, where the cost of sulfur has gone up. They're not getting sulfuric acid from there, but the cost of sulfur has gone up, which causes everything to rise. But just in general, and there they've had some taxes that have risen that have caused prices to go up. But if the world's largest and lowest cost producer of the commodity has had such a massive increase, that's working its way into all the others that are producing.
And you mentioned the bulk is produced in country. What percent of their sulfuric acid would be produced internally?
You're probably looking at about 80%, 85%.
Oh, okay. So in terms of what's happening in the Middle East right now, that's not impacting them because there's been a lot of chatter online that
price wise it could have an impact because just the general rise in the cost of sulfur with all that's going on. But in terms of getting it doesn't mean that they're going to get it because Russia and China, where they'll get some from, maybe a little bit from Uzbekistan. Again, it's very local, it's very regional, and they've had a significant challenge getting it the last few years. Their whole production has been below what their original expectations have been versus their what's called subsoil use agreements, and that's the agreement between Kazatomprom, the state-owned uranium miner, and the government. They could flex up or down 20% from the agreed upon amounts. They've taken the last several years a value over volume strategy because they recognize that it's easier, you're more profitable when you get price than when you get volume. And if you hold volume back, you're going to get higher price. So, they're still producing more this year than they did last year. But that's all factored into the supply demand math.
If I could just interject, what's their guidance for 2026 and how does that compare to 2025?
Their guidance will be up high single digits for production, which is, again, it's all factored into the deficits, and that's not a surprise to anyone. And we'll see. It doesn't always play out the way they originally planned for it. I've seen some people, I've had some funds will call us once in a while and say, "Oh my God, that's bearish, the largest producer in the world." Over the last couple of years, they're producing high single digits, whatever it might be. I'm like, who cares? That just because the largest producer is producing that, now do it in context, and now tell me you haven't done the supply demand work at any depth, because if you have, you'd know that that's all part of the alchemy, that it's all included in the supply demand work. So yeah.
all in all, the comments out of Kazatomprom, how would you frame it?
I mean, they continue to be very disciplined. Now, whether that discipline is forced by, a little bit of sulfuric acid challenges which they have been. Also, don't forget during COVID, they shut down just like everyone else did. And restarting an ISR well field is tricky. And so you still have, there were some lag effects there. Their ore body, if you look at their forecasts when they came public, it's starting in 28, 29, 30, it starts to fall off a cliff. So they're having to spend a significant amount more on exploration than they had originally planned. So you're looking at a double tripling of those costs. So the value over volume, as they say, is because they appreciate the impact on price versus volume. And I believe most of that. I think some of it is also it's more challenging for them to produce as much as they could produce. With them, we watch what they do, not necessarily what they say.
And Mike, with regard to the term market in 2025, according to UXC, 116 million pounds were contracted.
Yeah.
And here we are in Q1, the end of Q1 2026. What are your thoughts so far of what you've seen contracted in the term market? Both Cameco and Kazatomprom have signed long-term contracts with India. Maybe you can just speak to those, and what do you think?
which you don't see in the reported volumes. So, right, they big contracts you don't see. So we kind of take the reported volumes with a grain of salt for our own formulation of where the market is. Now, I'm fully aware that most sell side analysts are going to take it as gospel, right? So they take what the price reporter is reporting and they take that as gospel and that's what they put in. And so or investors are reading that. But there are some tells in the price action and volume contracting volumes that are reported that tell you that that's not necessarily the direction of contracting, because if we go back to 2023, you would have seen 165 million pounds contracted for. Now, our numbers will differ than what the price reporters and forecasters forecast for demand. So we would argue at that time, going back closer to 185, 190-ish, the forecasters would show less. So we would say that on the 165, you were pushing, over 80% of replacement rate. What do we mean by that? You use a pound of uranium as a nuclear fuel, as a nuclear power plant, you replace a pound of uranium. So going back since 2011, since Fukushima melted down, the replacement rate of contracting has been about 45%. And so in a given year, if, you're only replacing less than half of it. So by definition, you're drawing down inventories. Now, those inventories around the globe are very, especially in the Western world, are below 2 years. And that's where you start the fuel cycle is 2 years. So you're leaving yourself no cushion. So you would need to start to see contracting occur. So utilities have been drawn down, contracting hasn't occurring. Well, in 2023, 165 million pounds get contracted, it's 80%. Prices go, we're in the 50s and 60s on contract pricing. And remember, I said they're 90 now, ceilings of 160. So fuel buyers in 2024 said, we don't like these prices. Well, sorry, too bad. As they're learning now, the market shifted and they became complacent, and their recency biases and their anchoring biases to the prior decade have driven them off a cliff. And they're going to continue. That herd of fuel buyers will continue to fall off a cliff. And so what's wound up happening is 2024 came around and they said, you know what? We just had a decade of this and we control the market. We're stepping out of the contract market. Well, you can contract two ways. One is via a request for proposal, and that's more public. That's going to be sent out to everyone so that traders will know, the producers will know, investors might, if they're doing due diligence, will know, hey, there's an RFP on the market. And every week, the price reporters will report what they're hearing, the chatter they're hearing. So when utilities want to test the market, they send the RFPs out. Now, what you don't hear about, unless a price reporter picks it up through chatter, and they're usually the last to hear about it, is the bilaterally negotiated contracts. And that's where the vast majority of contracts are signed. And that is off-market, bilaterally negotiated, and not reporting. The utilities are adamant that uranium producers do not report the term, the tenor, the volumes, anything, or who it's with. And if you think about it's an absurdity in the uranium market. And we voice our opinion to the uranium producers. If you look at the offshore drilling market, for example, and you look at the providers of those rigs to ExxonMobil and Chevron and Shell and you name it, every time, or mostly every time there's a contract, they announce it. They talk about who it's with, what it's for, the price they got, the day rate they got. It's very public. The fuel buyers have kept their stamp and their thumb on on uranium producers where they don't report it. Now, there are exceptions. The Australian Stock Exchange makes those companies report it. There's only one producer down there. So now two. So you don't see a lot of activity. So on these bilaterally negotiated contracts, what you're looking for in 2024, you would have seen it wasn't 165 million pounds signed, but it was 124 million pounds that were signed. So it looks like, to the naked eye, wow, look at that. The utilities, they're stepping back from the market. They're playing tough guy because they don't like the prices. Well, the price of uranium that year on a decrease in volume of whatever, was it high 20s, 30%, the price of uranium went up over 20%. Now, you're in the commodity business. When prices go down, when volumes go down materially, prices don't go up. They did here. Now, fast forward to 2025, the same thing. Why? Because these were bilaterally negotiated contracts. A lot of them don't get reported. And so 2025 comes along, or, by the way, Jimmy, if some of them are getting picked up, but it shows you how tight that market is, how little capacity there is for even the small amount of pounds that they're signing onto contracts. Cameco, Kazatomprom, good luck trying to get them to sell you anything before 2030. They'll hand you the business card and say, sorry. So now they've gone out to the little developers or soon to be or producers, the little guys, and the utilities started to play the game of, well, we're going to go and get them to sign a fixed price contract, not the ones with the floors and ceilings where all the upside is, because we know that they need it to be able to go to a bank and get financing, to be able to go to an investor and say, rah, look at us. And so they were able to do that. But that's like picking up nickels in front of a steamroller, which fuel buyers tend to be good at since the price of uranium has gone up 5x in their face. And so while they could have secured all the pounds they wanted a few years ago. And so what's wound up happening is in 2025 came along, and what you saw was 116 million pounds being reported. And what happened? The price of uranium was up double digits again. So a fall off from 24 in volumes, from 165 in 2023 down to 116 million, yet the price has gone up. It's $90 today. Price has gone up over $30 a pound. Said differently, almost 50%. So it's a very dynamic, opaque, funky market that unless you're living in it, sleeping in it, the signals it sends off are not what's taking place in the real world. So it can be very misleading. The utilities have tried to game it. They did a wonderful job staying out of the market post-Fukushima, 2011. They let all those contracts they had expire. They were signing much lower price deals. They were doing a carry trade. So instead of locking into 5, 7, 10, 15-year deals, they were going to a trader and doing 1 or 2 year deals because they knew the market was oversupplied. They played it beautifully. But then, like everything in investing, and when you look at deeply cyclical industries, people's recency biases, they believe what's happening today is going to keep going on. And in an opaque market, that's kind of where you can really get in trouble. And that's where they've gotten in trouble.
Well, let's talk about what's going on now in the Middle East. And I can't believe what I'm paying for a gallon of gas now, or a liter of gas. So before all this craziness started, I was paying $1.15 a liter. Now it's up to $1.65 a liter. That's about an increase of 35%. Just for my US friends, that's $4.60 a gallon. Okay. How much are you paying for a gallon of gas?
$4. Change. Yeah. I just went on a weekend golf trip with a few buddies. We drove probably 300 miles, and I just saw I couldn't believe how much it had increased in just a few weeks.
So gas is up 30%, diesel's up even more, it's up 40%. And this is what tractor trailers and farmers and so many other industries use. Urea fertilizers up 40%. We haven't seen a move in uranium though. The spot market is relatively flat. Let's call it $85 a pound.
Yep.
What are
Yep.
your thoughts? Is this going to have any sort of impact at all on the uranium price?
Not really. I just think it's one of, uranium it trades based on what uranium's needs are. Fuel buyer, so the spot market, again, not even 20% of the market, some years a little bit more, some years a little bit less. Most of that, half to two-thirds of that is traders that are undercapitalized, getting offtake from mines, just selling pounds back and forth. In the last few years, they've made a living of trying to anticipate when Sprott will raise money and then go buy pounds. So that becomes their obsession the last few years. They try and front run that and then sell it back to them. But what's going on in the bigger world? You're not seeing pounds aren't coming from that region. They're not going through the straits. Most of the stuff.
What about another element of the fuel cycle, like enrichment or conversion?
Yeah, no, it's a great question. Russia is 40% of the enrichment market, so it's isolated there. There is it in France and the UK and New Mexico. So nothing to really cause anyone to go out and panic. What you did see last time, though, what has been interesting to observe is when the Russians and marched into Ukraine, nuclear or anything clean kind of caught a bid because it was like, wait, energy independence, right? Because you're blowing up pipelines and fossil fuels, and people were a little freaked out about what was going on there. The sell-off, uranium equity is probably down 15-20% since the war started in the last month, and fundamentally, there's nothing really that's structurally causing that. It's more sentiment driven, and that happens. Most of these companies don't generate revenue, right? They don't generate revenue. They don't generate cash flows. Most, not all, but most of them are exploration development companies. The few big ones that they've sold off too, but the actual commodity itself has not really been impacted.
Well, Mike, this has been a great discussion. I want to thank you very much for spending time with us today. And as we wrap up, I'm going to put you on the spot now. And I want you to get your views on where you think the spot market is going to be and the term market is going to be at the end of 2026.
Spot, I don't, if spot's not, so it's 85 today, I see no reason why it can't be in the mid 90s, pushing 100. And I'm just pulling a number out. I think again, famous last words, but I feel like there's bids in the market in the low 80s that come in. So I feel that asymmetry there. On the term market, Jimmy, the reported contract price, which I was saying earlier, which is not really, that's a small portion of the price. I think that keeps marching higher. So I would expect to see that over $100. And I would expect to see ceilings continue to rise. You never see a catalyst coming. So, I've said this before. I look for conditions, and the conditions are such where, if any of our work, the supply-demand work, if we're directionally right, which I believe we are, something that we're not thinking about is going to cause something and somebody to panic. And what I can say from talking to fuel buyers, some of the fuel buyers are some of the smartest people you'll meet and very commercial. So I don't expect the top fuel buyers in the world to wake up one day and go, "Oh my God, we should have ordered uranium." Right? That's not what happens. It's the tiers below where these folks, we just talk to them, very smart nuclear engineers. They run the power plants. Thank God for them. But they're not commercial. They're not in the market a lot. And it takes one of them, one to panic. And the conditions are such where, that's where you can start to get some goofy pricing. And that wouldn't surprise me. I think we're at a point where they need to be, the inventories are what they are. They need to start coming into market. So yeah, I am, again, I don't like to sound like I'm not a permeable, but the conditions are such where it's very asymmetrical for rising prices and it could be significant.
And in all probability, it's going to be a geopolitical event that forces them to make a move. I mean, nobody foresaw what happened in 2022,
Totally.
and
Totally.
very few people anticipated what was going to happen in early 2026. But
I feel like a broken record a lot to myself and my guys working for me, where I say, "Well, that wasn't on my bingo card, whatever it may be." I'm like, I hadn't thought of that, and but the conditions are such where it's beneficial.
well, Mike, once again, thank you.
Thank you, Jimmy. It was really nice catching up with you.
Justin, thank you very much for joining us today. How are things in California?
Things are going great. Happy to be here again, Jimmy. Thanks for having me.
It's a pleasure. So we're living through some tumultuous times right now because of what's happening in the Middle East. Inflation is coming back with a vengeance. The price of gas is up 30%, give or take, throughout North America. Diesel's up 40%. Urea fertilizer is up 40%. And every $10 move in the price of oil is equivalent to 25 cents at the pumps. How much are you paying for a gallon of gas in California?
I paid $6.40 yesterday, and it's expected to go higher. And there's a number of elements. Almost half of the price of gasoline here is in fees and taxes that are unique to California.
And 640, is that for premium or regular?
640 was premium. We also have refineries shutting down in the state and moving to other states. They're done. They're done putting up with all the regulations here. So it's truly sad what the bureaucratic leadership has done to the state on that front and many other fronts. But the weather's great.
Yeah, and you can go surfing. So I'm based in Toronto, as you know, and I was paying $1.15 for a liter of gas back in January, February. Now I'm paying $1.65. And when you look at the FX and you convert it over to gallons, it's about $4.60 a gallon. So I can't believe we are actually significantly cheaper than California.
Yeah, it's definitely a bummer. It makes it really hard. California especially has really poor public transportation. So there's a lot of middle class people that are commuting an hour or 2 hours each direction to work. That's really, really squeezing them in a bad way. So hopefully not only just the price of oil stabilizes and drops again at some point, but that California can make some changes, hopefully with some leadership changes later this year. Knock on wood, not holding my breath though, unfortunately.
So we know what's happening with the price of oil and its various products, but the situation that's happening in the Middle East, do you see that impacting uranium in any way or any aspect of the nuclear supply chain?
So uranium is kind of a unique, in many cases, disconnected market from a lot of other markets in the world. I know that oil, generally speaking, affects most things. And very simply, if it's not obvious, the cost of diesel, the cost of oil, the cost of gasoline, that increases mining costs globally. So that should translate to higher sales prices for the actual producers, which I'm sure that it will in time. It doesn't reflect in, day-to-day moves in the spot price necessarily, but that will have an accretive effect over time. One of the elements that we're watching is the impact of sulfur. So something like 40 something percent of the world's sulfur is exported through the Strait of Hormuz. And sulfur oftentimes is either converted to sulfuric acid and utilized as a lixiviant for ISR production or as a reagent for actually processing above ground, ore that's pulled out of the ground in underground or open pit mine. Kazatomprom is the big one that uses sulfuric acid, but Kazakhstan largely produces their own supply of sulfuric acid. The acid that they need beyond what is produced in country, they typically buy from Russia. So they don't really see an interruption in the sulfuric acid market as of yet. To some extent, it's a global marketplace. It could increase the costs for them, and they're watching it. If this persists, it could have downstream effects due to that global market, but so far not impacting them. The bigger impacts could be if this persists, of course, in Africa, more specifically Namibia, and in some cases potentially Malawi as well, with the producing Lotus is producing there from Kyalakira, and they use sulfuric acid. So Husab uses sulfuric acid as a reagent. and they have their own acid production facility, but they import the sulfur, and that all comes from essentially from the Strait of Hormuz, from the Middle East. They likely have some inventories. It's kind of a little bit of a black box, but if this persists, I would argue for more than another, let's say 2, 3, 4 weeks and beyond that, if imports specifically of sulfur to Namibia are impacted for that period of time, we will see that affect actual production of uranium from Husab and to a lesser extent from Rossing. Langer Heinrich uses a different reagent, so they're not affected in that way. So in that way, there's some disruption. Of course, the overall costs rising. And then, we were chatting about this before you hit record, and I think this is kind of a bigger, more longer term theme, but a lot of the increased adoption of nuclear energy that we've seen over the past few years, right? We've definitely seen the projected growth of the sector go from 1% in 2016 to 4% compound annual right now. There's 74 reactors under construction globally right now. Half of those are in China, roughly. And more countries are looking at restarting idled reactors, life extending their existing fleet, and building new nuclear reactors. And a potential comparison would be to the 1970s oil crisis, where we saw the prices skyrocket for oil. We saw actual concerns about available supply of gasoline and of oil. And during that period of time, the United States and France specifically, but multiple other countries, Japan, rapidly built out nuclear reactor fleets. So almost on a daily basis, we're seeing some new announcement of a new, whether it's a data center company or an actual sovereign country wanting to build nuclear, making some new letter of intent, MOU, with a nuclear reactor designer or builder. It's happening on a daily basis. And so many things are happening in terms of life extensions and restarts. Taiwan wants to restart the reactor they shut down last year. Belgium is looking at restarting a reactor they shut down in 2024. France has given essentially blanket approval to their 900 and 1300 megawatt reactor designs, which is 95% of their fleet, to operate out to 50 years. Now, each individual reactor will have to be assessed and approved, but they have approved for those designs to operate to 50 years, and they're looking at 60 years. And I posted on Next the other day, this 10-year life extension of the bulk of their fleet for those two reactor designs, extended for 10 years, is almost 250 million pounds of demand in that 10-year period, which effectively will consume all of the life of mine production coming out of the Arrow mine that has yet to be built. This is NexGen's big project. This is the linchpin project to balance supply going out for a point in time in the early 2030s if it's developed on time. And on a pound basis, all of the uranium that will eventually come out of Arrow has effectively just been consumed by this one 10-year life extension of the fleet of one country. So that's the direction this is going. As far as specific interruptions based on the war in Iran, the blockage of the Strait of Hormuz, the sulfur is the biggest impact in the uranium sector, but that only affects certain projects. And if it doesn't persist for much longer, we probably won't see a lot of interruption to actual production.
And just because you touched on Kazatomprom and their 2025 numbers, were there any other concerns that came out of that call?
I wouldn't say concerns. I think everybody was listening for detail on sulfuric acid. We already had been doing some work on this, so we knew that they were likely not impacted by this situation. I would say the most shocking element of the earnings, and we've known this as well because we've been tracking this for many years, but more and more of their production is heading to China and Russia, of course, but China is the biggest buyer. So not only is China the second largest JV partner with Kazatomprom, Russia being the first, they're the biggest buyer of uranium. So they have multiple projects that they're joint venture partners with. They have that offtake. And then they also contract with Kazatomprom for future delivery of uranium. And I believe it was almost half of the production of the sales for 2025 last year from Kazatomprom were to China. And of course, they noted and reiterated that the bulk of the production increase that we saw last year and they're expecting this year, right? I think they're expecting about a 10% increase in production this year over last year, is all from this Budenovskoye 6 and 7 project, which is the big joint venture with Russia. And all of the production out of that project this year, 100% of it goes to Russia. Starting next year, that'll be, a 51-49 split. But Russia, I'm sure, will be able to negotiate purchasing Kazatomprom's share, or at least part of their share from that project. So when you see Kazatomprom's expansion and the numbers rising their total production, yes, of course it matters. Yes, we count it. That production is going to Russia, and Russia is pretty severely short uranium. So it's not, there were no real surprises there, but it is very notable to see more and more of this largest producer in the world of their production remaining in the East.
And just to clarify, did they produce 70,000 pounds last year?
They produced, let's see, they produced 25,000 tons, which, wait, hold on, am I getting that number right? I think it was, yeah, 25,500 tons, which was about 70 million pounds. Yes.
And half of that went to China.
Well, that was the total production numbers. The actual sales that they made for last year, almost half of that went to China. From Kazatomprom on an attributable basis, not the total production out of the country. So about half of their production in country, half of that went to China. Still a lot of that, but also on the 100% basis, because China has a lot of joint ventures and offtakes from those projects, even more than that 25%. I don't have the numbers right in front of me, but it's probably about a third of the pounds coming out of the ground in Kazakhstan are going to China on an annual basis. And that number is only going to increase.
So believe it or not, we're already through Q1 of 2026. I can't believe it. But what's your assessment thus far in the last 3 months of the activity in both the spot market and the term market?
It's been an incredibly volatile year so far, especially in the spot market. The term market is doing what we expected the term market to do, which is just slowly chug higher. We're now sitting here at $90 a pound in term. That is reported by both UXC and Trade Tech. That's going to keep going higher. There's solid demand in the term market. It isn't crazy euphoric demand, and it's not dead. It's moderate. There's multiple utilities in there with RFPs. There's multiple other utilities expected to come in. We did see large contracts signed this year already with from India between both Kazatomprom and Cameco. Very large contracts. That alone is adding to more activity in the term market and going to help keep the price aloft. The spot market went on an absolute tear right out of the gate for 2026, and we saw almost $500 million flow into the Sprott Physical Uranium Trust in January. And they've already purchased more than 5 million pounds of their 9 million pound allotment for the year. So I think it's actually pushing close to 6 million pounds that they've purchased annual to date. So a huge amount of capital came into Sprott and came into the sector in January that peaked out late January into the early part of February. Since then, we've seen consolidation. We've seen the spot price pull back down. Today, we're trading 83-ish in the spot market, which is a $20 drop from the high print of late January. With all of that said, the carry trade kind of works here. We expect, barring a more severe risk-off environment, we see kind of a liquidity event. We could see some pounds being motivated sellers in the spot market offering up pounds. That would primarily be from some of the financials like hedge funds that are holding a little bit of uranium. We haven't seen any evidence of that yet, but it could happen in a risk-off environment. Barring that, I think that the low 80s are sort of a floor here, not a super firm floor, but any midterm demand on behalf of utilities, traders can buy at 80, 81, 82, 83 and sell that in the forward market in the low 90s in the carry trade. So we shouldn't see too much more downside in spot here. Again, big caveat, barring some kind of liquidity event. But even if all of that happens, it's a incredible buy the dip opportunity. We do still have some cash here in our portfolios, but because of this kind of contentious situation and kind of the ugly looking broad market charts, looks like they're rolling over pretty hard here. How steep they drop from here, if more, I have no idea. I don't have a crystal ball, but it's a strong buy the dip opportunity because everything looks very, very solid going out mid and long term for the sector.
And why do you think there was so much volume going through in the first 2 months? You mentioned 6 million pounds. Like, where did that come from? Did that surprise you that they were able to acquire so many pounds in such a short period of time?
No, not necessarily. I mean, they made a big purchase when they were raising a lot of cash and they were waiting for approvals from the regulators, not only to re-up their ATM, but also to extend that or reinstate that 9 million pound ceiling. So they were being very careful about how much they were buying in the market. Meanwhile, the capital kept flowing in. So I think that there was, obviously financial interests in recognizing the situation that they were going to be at a few percentage premium to NAV, and that all of the capital that they could put into the vehicle would go to buying uranium. When they're trading, at a few percentage discount, it doesn't matter how much money comes into it. If as long as there's selling pressure to match that off, they're not going to be able to raise capital by issuing the ATM that would go directly to buying pounds. But because of that situation, they were trading at a small premium consistently. The capital interests knew that money going into that vehicle would go directly to buying uranium. So I think they took advantage of that. I think that unique circumstance led to a lot more capital flowing in than we would have seen. But we also just came out of December, which had some volatility around the ETF dividends and the rebalances and things like that. So I think that there was a lot of portfolio shuffling that happened in December, and then you just have a fresh start in January. So I think that there was a lot of financial interest just kind of waiting in the wings for the new year. And as soon as the capital started to flow, as soon as it was obvious that Sprott was kind of in this tight spot, they couldn't go kind of slam into the spot market buying pounds because they didn't want to upset the apple cart while they were talking with the regulators about both the ATM and the limitation for the year, their allowance. So that I think was a unique set of circumstances. And now obviously we have broader concerns that have capital sort of sidelined here.
So let's talk about what's happening in the U.S. now. And just as a reminder to our viewers, the U.S. is the world's largest consumer of uranium. 20% of their grid comes from nuclear energy, and they consume 45 to 50 million pounds of uranium every year, yet they only produce 1 million pounds, give or take. And with this in mind, the U.S. government under the Trump administration has gone all in on nuclear energy, and they've also implemented a number of executive orders to push this whole narrative and also to build out the uranium supply chain. What are your thoughts on what the U.S. government is doing right now? And maybe you can also speak to this U.S. Strategic Critical Minerals Reserve and whether or not you think they're going to start buying uranium.
Sure. So last year it was announced that the Japanese would be contributing to and establishing a fund that was purported to be north of 300 billion that was going to be invested into United States infrastructure and critical minerals types projects. And at the time, it was stated that 80 to 100 billion of that 300 plus billion would go directly towards building new nuclear power plants. That was, I think, back in October, November of last year. And the sector reacted, of course. It soared on that news. The Japanese Prime Minister Takaichi visited, and I believe is still visiting President Trump right now. And she was there yesterday. And it came out yesterday that about half of that initial stated allocation towards building new nuclear, 40 billion, would be going to building GE Hitachi small modular reactors in both Alabama and Tennessee in the United States. So that's most likely that Tennessee Valley Authority that I know was already interested in building BWRX 300s. So that element came out yesterday. That, of course, is only half of what they've been previously announced, but it's still incredibly bullish to be building these reactors. And is from what we can tell, that GE Vernova, GE Hitachi, BWRX 300 is probably the most widely adopted SMR design right now as far as early construction and actual pipeline projects. They're building 4 of these units at Darlington, Ontario currently. So they're already approved up there. Still don't have NRC approval here, but it's in the works. It'll happen. So that's very good news. We still think there's a remaining element coming out of this that is for the AP1000 to build some large AP1000 reactors. And part of the executive orders last year were that President Trump wanted to see 10 large new reactors under construction by 2030. So we still think that news is coming. As far as other new builds, there's multiple in the works. Obviously, we have the TerraPower's Natrium building being built and constructed in Wyoming right now. They have that early construction permit, so that's actually being built. Then there's multiple other small modular reactor designs that are in early stages of of approvals, and construction should be starting within the next 12 or 24 months on multiple fronts in the US. So all things in that front, on that front are going in the positive direction. Big power plants are requesting life extensions. The second largest in the country, which is the Palo Verde station in Arizona, is requesting NRC approval to operate out to 80 years, which would take that operation into, I think, the 2050s or 2060s. So that's the kind of environment that they're operating in here. As far as the strategic uranium reserve, we haven't really heard anything on that front. I don't really know for sure if this is going to happen. There were whispers about this last year. It did look like they were moving towards that. I'm sure that there's pressure from the nuclear utility lobby to keep that from happening. But for now, it's moving that direction. We're not holding our breath for that. What that would look like, quantities, etc., not exactly sure. But it's not really needed. We don't model for it.
And I'm sorry, how many nuclear reactors did you say they want to start in construction before 2030?
Well, the executive orders of last May aim to have 10 new large reactors under construction by 2030.
Right. So that'll take many years to build, right? Like, what are we talking? 10 years?
Yeah, so the last assessment that was done by Westinghouse, and I believe that was even potentially in collaboration with their partners Brookfield or Cameco and Brookfield for Westinghouse. They might have even had some collaboration with elements from the federal government, but they believe that that would be about a 7 or 8 year build for those large new AP1000s. And I think that's possible. You know, the first one at Vogel went way over schedule, but the second unit was built for almost half the cost and almost twice as fast as the first unit. So we just kind of need some economies of scale and some momentum with these things to really get it under control. But it's still pointing in the direction that that'll happen, but we don't model for it to happen, so it's not a need. It would be great to see it happen, not only just for that increased uranium demand out in the 2030s, but also just kind of the signal to the West that the US is back and we're building new large projects like this again. In many ways, that will give permission to other countries that might still be a little bit kind of gun shy because of the cost and time overruns of Vogel.
And I guess when I hear you talk about this, the first thing I think about is, okay, they already consume 45 to 50 million pounds annually. The US produces virtually none. Where the hell are they going to get the uranium to power these things?
Yeah, so the US is ramping a bit. So last year, 2025, we believe there will be about 3 million pounds produced in the US, and that'll continue to slowly rise. I think getting past that 5 million pound number is going to be a challenge in the United States. You know, traditionally, the United States utilities buy a lot of uranium from Canada. They buy a decent amount from Namibia and Kazakhstan, but Canada is the biggest uranium purchase, the biggest source of uranium for the United States, and has been for many decades.
And we've seen the US government take equity positions in a number of resource companies, Lithium Americas, which is building a lithium plant or a lithium mine in the state of Nevada. They also took an equity position in Trilogy Metals, which is a copper deposit up in Alaska. Do you envision the US government doing the same sort of thing with a uranium name, or are they just too small?
It's so hard to say. It's possible that they're just too small, and also there aren't any like super meaningful producers in the country. So it's a difficult one to say. It would make sense perhaps for them to take a small stake in certain producers that are actually producing now, but haven't seen it yet. So not sure if it's going to happen. That's a difficult one.
And Justin, why don't we just talk about valuations now with the equities and the price of uranium, both in the spot market and the term market? It's hanging in at, let's just call it $85. But the stocks have come off quite a bit, 20 to 30%, depending on what you're looking at. And I guess it's just risk off. All the gold equities are off a like amount too. Price of gold's down 10 to 15%. But what are your thoughts here from a valuation point of view when you look at a producer like Cameco or a developer like NexGen or Denison? Are they good values in here with this pullback?
I think that there are some decent value propositions in the space right now. You could argue that a few companies are overvalued. You could argue that there's a few that are severely undervalued. Valuation based on the price of uranium has never really been that much of a consideration or even a driver of capital flows in this sector for whatever reason. It just seems to be more based on actual capital flows coming into the large caps and into the ETFs that moves everything. And that's kind of just always how it's been. You don't really see a whole lot of discounted cash flow analyses of the producers or the to be producers. If you were to do one, for example, for let's say NexGen at this valuation, I would argue that it's probably fairly valued at $80 uranium at this price. But of course, the markets are always discounting mechanisms. You go out 2, 3, 4, 5 years down the road, what is the uranium price going to be? What's your discount rate? And how much uranium is XYZ company going to be producing? If NexGen is producing from Arrow and they're producing 15, 20 million pounds a year and the price is $150 to $200 uranium, and they're developing in early stages of developing of Patterson, the Patterson Corridor East at the same time, what is that company worth? Right here, it's worth 4.5, 5 billion. Maybe it's a 20, $30 billion company. Hard to say. So based on the current uranium price, you could argue that the sector is somewhat fairly valued, generally speaking. But of course, once you start to price in where the uranium price has to go, let alone where it likely will go, then these things are severely undervalued if you believe that future is coming in the next few years, which we do.
And what about a name like Denison or NexGen, because they have all their permits, they're totally de-risked. Well, they still have to build the mines, but do you anticipate somebody might come in and try to acquire one of those companies just because they have all their permits now and they can move toward construction?
That's the $1 million question, right? I mean, that's what everybody wants to know. As of now, we have yet to see any real evidence that is going to happen. I think that a lot of investors in this sector have been pounding the table for many, many, many years, wanting Cameco to come in and do an all-paper transaction and take the thing out. They haven't done it, despite the fact that on multiple occasions over the past 5, 6 years, we've seen extreme relative valuations for Cameco compared to NexGen. So they don't seem to be interested. If you ask them directly, they'll just say, yeah, we've got plenty of tier 2 and development projects in our pipeline, so we don't really need it. That's what they say. Will a multinational mining company major come in and take out Arrow? I don't think any of these guys want to actually build the mine. I really don't think that BHP or Rio wants to come and build Arrow. So more than likely, NexGen is going to be going it alone with actual construction. The most interesting piece of news that's come across the tape, I think, for this whole year so far, is Leigh Curyer mentioning that they have been in direct conversations with hyperscaler, like big tech companies, for project finance for developing Arrow in exchange for an offtake agreement. And that, I think, has profoundly deep ramifications, not only for the company and the outlook for the project going forward, but of course, just for the entire sector and the fact that it is possible, in fact, likely, that on a 5-year time frame here, we could have utilities in competition with the largest companies in the world for actual uranium. And this isn't far-fetched whatsoever. We actually saw Amazon, within the last 6 months, make a direct deal with a copper producing mine company in Arizona for copper offtake. Amazon wants the actual raw copper. And they, of course, are one of the big companies that's expanding the AI data centers and likely going to be more directly involved in this whole process. So the fact that NexGen is seeing incoming interest from hyperscalers for project finance and offtake, I think is an enormous, enormous development. And it bodes well for the company. However, they are entering that difficult part. It's as difficult as exploration is in finding a deposit, and it's very, very hard. That is relatively easy compared to building a mine. So now they're entering that phase of, okay, I guess we're building this thing. Is from what we can tell, they've built a decent team to do so. They have all their ducks in a row. So they're going to be shovels hitting the ground in the coming months, more than likely. And the other element of this company I think is so interesting, besides the fact that they're getting into this development stage, is the fact that they have this kind of burgeoning new deposit at PCE. And so there's this potential another Arrow right next door to the project they're building now. So it's a very, very interesting company.
I almost wonder too if it's going to be someone else we're not thinking about. And I bring that up because The one thing we didn't talk about it was the importance of jurisdiction, right? So you had this scarcity element. You're in one of the greatest mining jurisdictions in the world. That deserves a premium. And I'm going to look at the gold sector now. Agnico, it's the second largest gold producer in the world. 70% of the production comes from Canada. So it's always trading at a premium to its NAV. And we just saw a Mexican company called Fresnillo, world's largest silver producer. They acquired a Canadian-based gold developer based in the province of Quebec. I believe that was late in 2025. They paid about 800 million. So, fairly cheap when you look at a name like NexGen. But I'm wondering if it's somebody else who wants to kind of de-risk their portfolio and move toward a safer jurisdiction.
It's possible. It's just such a small universe. There's only so many companies that are potential suitors. Like I said, the big multinationals have the cash to be able to do something like this, but I don't know that they have the interest. We've seen companies that have historically been in uranium in past decades just largely divest and get out. And obviously, we had a very, very long period of time coming from, the early 80s all the way to like 2003, where the price was just leveled by secondary supplies, absolutely leveled. And then we had a blip from '04 to '07 and then back into another bear market. And, I think that the multinationals, they want to be in sectors where maybe the underlying asset or the underlying, I should say, the underlying commodity is a little bit more predictable and stable, and or the asset can make money in any environment. So they look back 10 years and saw it was 18 bucks a pound. Okay, so NexGen says they've got cash costs below 10. I doubt that mine is making money at $18 a pound. And it's not going back there, but they haven't done the work on the sector in the way that even you or I have. So for them to see the historical uranium price chart and it's basically like this, it's not that attractive for them to pile billions of dollars into something and take that risk. That's my opinion. I could be wrong. I don't know. I'd love to be wrong, but that's what it looks like. As far as other uranium companies, the big ones, Kazakhstan, Kazatomprom is not going there. You have Cameco and Orano, and they're already established as JV partners for both Cigar Lake and McArthur River, and then the Key Lake and McLean Lake mills. And both of those assets are going to be done producing by 2040, 2041, Cigar 2035. So you have these two big mills that need feed. They're not going to be trucking ore from the southwest of the basin over to McLean Lake or Key Lake. I don't think that's going to happen. So it would be mine and mill construction as NexGen has planned in their engineering plans. But I don't know that it makes sense for either of those companies to go after them, because they have these very important already established mill assets where the feedstock is dwindling. So they're more than likely going to acquire or develop their own stuff in the eastern Athabasca in order to feed those mills. That looks to me like the most likely outcome. But again, I could be wrong.
So you mentioned this a couple of times, Justin, but when it comes to uranium, especially, you got to be very patient because it's like one step forward, two steps back. It's the entire market can be quite volatile. And because of that, a lot of investors are frustrated because we're not seeing the move that we had anticipated. What would be your messaging to investors who are involved in the uranium space?
Sure.
Especially
Well,
after the past week or 2 weeks, right? When you see your uranium equities lose 20 or 30% of their value.
yeah, so I would say that, well, first of all, it's really, really important to have a grasp of what's happening in the physical market. For that reason, we have a trading portfolio that's done extremely well. So it's a very, very tradable market, especially when you consider if you have a very confident view that we are in a long-term bull market, these big gut-wrenching pullbacks that shake out 10 or 20% of retail, and they get shaken out. You see the complaining on social media, which I haven't really seen that much yet, but it'll happen if we see weakness for another few weeks, which is possible here. That poor sentiment, low RSI, 20, 30, 40% pullbacks that we get once a year, sometimes twice, those have always been buying opportunities. And they will be until we are no longer in a longer protracted multi-year bull market, which we are. for the commodity. And if you look at most of the charts in this space, we're in a bull market for the equities as well. So I would correct you and say I think we're 2 steps forward, 1 back, not 1 forward, 2 back. And that's just how it goes in this sector. It's an extremely unique and opaque sector. It's very difficult to get accurate information, but if you have access to know what's happening in the physical market, it can greatly assist in your ability to trade this market. This is why we have a large cash position here, because we intend to put that to work on these pullbacks. That has largely been informed by what's happening in physical. So if you just get caught up in kind of the news flow and the sentiment things, and you end up buying in the highs and selling the lows, that's and these types of things are not unique to uranium. It's just a classic that most people get caught up in sentiment and trade with their emotions, and you always want to trade against your emotions, especially in these cyclical resource stocks. So what I would say is do what you can to have that information. Of course, we provide that information at Uranium Insider, which helps our members trade along with our dynamic model trading portfolio, which is up 95% since last February. And we've knocked it out of the park with this portfolio because of these trading signals. But you just have to be patient. There's always a little bit of inventory in this world. And that's because we have a fuel cycle that takes 2 years to go from mined uranium to fabricated fuel because of that lag time. It's not a tanker that shows up in normal conditions every other day or every other week or whatever it might be to keep a coal plant running, for example. You have to have inventories because you can't just place a phone call and have fabricated fuel the next day at your plant. You have to have inventories. So as the price ebbs and flows, you'll see utilities step in, step out of the market kind of at their will. With that said, they do have to pay what the market is asking when they do need to buy. And on an ongoing basis, a utility here, a utility there will have to buy. And we see a dozen utilities in the term market right now because they have to buy. They need uranium delivered 2, 3, 4, 5 years from now, and they're in the market now to make sure that happens. So there's always some flexibility in the system. There's always a little bit, and you can't let that frustrate you. How is it possible that Sprott bought 5.5 million pounds of uranium this year? How is that possible? I thought this market was thin. There's always some production coming out of the ground in the spot market. It's not a static basket of uranium that once it's gone, it's gone. There's always production. It's always happening. Production is responding. It's still far insufficient to meet demand, but secondary supplies and inventories are things that buffer this market and create these periods of time where the market can go quiet, then the market comes in. And then the last thing I'll say, Jimmy, to that question is that, again, it's wild to even say this because I started watching this market back in 2017. Here we are in 2026. The big event has yet to happen, and that is replacement rate contracting. If we see 180, 200, 250 million pounds contracted in a single year, we're going to see a moonshot for the commodity. And that is something that we are going to see have to happen in the coming years. So everything is going in the right direction across the fuel cycle. Demand for uranium is strong and growing. It's all still happening. You just have these moments where the market can go quiet. The spot price can spike well above term and come back down. This is going to keep happening. So don't be surprised when it happens. Just be on your toes to trade against your emotions and take advantage of that volatility.
And I almost wonder if could be another geopolitical event. I mean, you look at 2022 and how Russia and Ukraine changed the whole profile of this market, and then what we have going on in the Middle East right now with oil. If there were some other geopolitical event that we're not even thinking about, which could take the price of uranium significantly higher, like from $100 a pound up to 200.
Sure. It's the market is relatively fragile. The conditions are there for disruption for multiple reasons. Geopolitical events potentially one of them. And we saw the market get shaken up, like you mentioned, 22, with Russia's invasion of Ukraine, not because Ukraine has any meaningful element of the uranium fuel cycle, but because Russia does. And what we saw were multiple elements of sanctions on Russia. A lot of Western fuel buyers decided to not do business voluntarily with Russia any longer. So that shook up the market. Interestingly, we saw conversion and enrichment, which Russia has the largest stake in both of those services. Those went to all-time record highs in price. And even though the demand has pulled back substantially right now for both conversion and enrichment compared to 2, 3 years ago, the price has stayed high. Very, very interesting. So that can shake things up, but so few countries contribute to this vital supply. It's Kazakhstan, Canada, Namibia, Australia, Uzbekistan. I mean, those are the big five. And if there's any disruption to any of those countries, it has meaningful effects downstream. So I always say that we don't have to know exactly what is going to disrupt. We just have to be aware that the conditions are such that disruption can happen. And they absolutely are. I've talked a lot about NexGen's Arrow. That's a very important project for multiple reasons, but I'm telling you, what utilities do is what, kind of early stage investors do, which is read the feasibility studies. They go in and they see that, okay, this is going to be producing 29 million pounds in 2031. Great. We have nothing to worry about. Well, they haven't done the work to see that Cigar is done in 2035, to see that all the projects in Kazakhstan, not all of them, 80% of them are going to hit decline rates around that same period of time, if not earlier. And the likelihood that Arrow is not going to produce 29 million pounds. They can dial that down. In fact, the company has started to even use that language that, they only need to produce, 5 million pounds a year to break even. So they can produce according to the market signals. They don't have to produce 29 million pounds for the first 5 years. They don't have to do that. In addition to timeline slippage, right? So they're already saying 54 months. If they start construction, in the middle of this year, we're talking 2031 ramp up, 2032 first production, which is already 3 years behind what they expected, 18 months ago. So timeline's already slipping. It's a vital, vital project that utilities are absolutely relying on coming to fruition on time, on budget, at the stated volumes. Though none of those things are guaranteed. So any more slippage there is going to have reverberations in the market, in addition to decline rates in Kazakhstan. All of these elements are very clear to us in our models. We don't know where the supply is going to come from in the 2030s to balance this market. And that sounds like it's a long ways away. It's not. That's where the utilities are shopping right now. So the future exists right now in this industry, and we don't see any reason for the long-term price to stagnate for a long period of time or even fall here. It's going to keep going higher. The spot price will get pulled up by the long-term price in a quiet market. In a not quiet market, we're going to see more spikes like we just saw.
Great insights, Justin. And as we wrap up, this has been a great update. I want to thank you very much for spending time with us today. If someone would like to learn more about your services or follow you online, where can they go?
UraniumInsider.com is our website. I'm decently active on X at Uranium Insider as well.
Justin, once again, thank you.
It's my pleasure. Thanks, Jimmy.
Well, that concludes our conference, and I hope you found it useful. We have some amazing virtual events coming up here in the coming weeks, so be sure to subscribe to our channel, Bloor Street Capital, and also hit that notification button to be kept up to date on upcoming events. You can also follow us on Spotify and Apple Podcast. Thank you very much for being with us today, and thank you for your support.